ditch fossil fuels and save the planet. Unfortunately, it's not that simple. There are some things where you just need a good old-fashioned combustible fuel. Now, startups around the world are betting that hydrogen can become the fuel of the 21st century.
China is not as clearly a black and white story as it used to be, which is if China's growing, that helps the world economy.
COVID now is hitting China quite hard, and this will impact the economy. However, we do see it as a positive net-net, because then China will move away from COVID just like the rest of the world, and this is a positive story.
There will always come a day when we have to make a big decision about normalization. That is exactly what we are doing now, because the time is appropriate for us to do it.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kayleigh Lines.
So 10 a.m. in London, 5 a.m. in New York, 6 p.m. in Hong Kong. Our top stories today. As China opens the floodgates for foreign travel, other countries say not so fast. Japan and Taiwan reimpose testing. The US is considering a similar move, warning that things could change, quote, quickly. The yen drops as the Bank of Japan announces unscheduled bond purchases, pledging once again that yield curve control will continue. And Sam Bankman-Fried, plus another executive, borrowed more than $500 million from Alameda Research to fund a stake in Robinhood. The question now is, who owns the shares? We're going to have the latest on that story. Welcome to Bloomberg Surveillance, the Early Edition. I'm Guy Johnson in London, Kriti Gupta and Kayleigh Lines, both in New York. Anna Edwards is off. Matt Miller will be co-hosting Surveillance in the next hour with Kayleigh. Talking of which, Kayleigh, the Bank of Japan is back.
The Bank of Japan is back. Arguably, they never went away, even though we did last week get somewhat of a pivot with changes to yield curve control. But I would stress those are changes. That wasn't the evaporation of the yield curve control policy, which is why we saw action from them overnight. As for the overnight session as a whole, it was a bit mixed. You had stocks broadly lower, the MSCI Asia Pacific Index down by about 0.2%, but we did get outperformance from Hong Kong. The Hang Seng there up about 1.5% because more reopening news from that area in particular came out overnight. They are now scrapping most of their remaining COVID rules, including limits in public gatherings, as well as vaccine requirements for certain venues to enter them. So that lifting sentiment there. But broadly, the China reopening story is fueling fresh concern about inflation. That really has driven a bond sell-off globally. It started with treasuries here in the U.S. yesterday. It continued in the Asia Pacific overnight, where the 10-year Australian yield jumped 21 basis points to 4.03%. And of course, that is where the Bank of Japan comes in, takes a look at yields rising, says, no, we do want to maintain that control. So they announced more unscheduled bond buying. And that is what is driving weakness in the Japanese yen, because the BOJ at the end of the day, Kriti, is still dovish. So the yen weaker against the dollar by 0.4%, trading right around 134.
You know, and Kayleigh, I think that slightly stronger dollar is something that you're going to see a reversal of in the last 2 days. And this is really significant because as we talk about what's actually driving the U.S. trade, I would argue it's still the dollar. Take a look at futures. They're not doing much of anything, even though you do see a little bit of a bid into the greenback. To your point, the 10-year yield, though, also only down 1 basis point. So not seeing a ton of action in pre-market trading. That could all change as more and more people get right back to the trading desk. Really keep an eye at those opening bells. To me, I think what's really interesting here is the divergence you're seeing between risk assets. The commodity story, NYMEX crude trading at a 79 handle, down only about 0.6%. Put that in a volatility-induced context, and it isn't actually a massive move. But on the other hand, you do have futures inching just marginally higher. So it's interesting to see that you might actually see that divergence. If you actually have crude lower and stocks higher, that tells you a story in itself. Bitcoin as well, the risk sentiment perhaps a little under the weather today. To your point, Kayleigh, down about 0.2%. Guy, I would say nothing to write home about in U.S. market trading, but I'm going to say that and then I'm going to jinx it. So I'm just going to let you take the wheel from here.
I will take it on, but I think I'm going to continue the sentiment. Europe is open, but it's not. It's open in name, but not in spirit. You are looking at the London market up a little bit. Commodities are outperforming. France is absolutely flat. DAX is flat as well in Frankfurt. there is nothing to see here. Go to your Bloomberg terminal, take a look at the AVAT function. What it will tell you is that volume is super light. I can attest to the fact that the trains were empty this morning. Nobody is here, nobody is trading. So the Stock 600 is up by just a mere 0.2%. Spot 6.7 in terms of points. We're trading at 428. Dig in though, the sector story does have a story to tell. And what you're seeing here is the basic resources sector outperforming. We were just mentioning what's happening with the energy story. Commodities, the metals, up today. UK natural gas, I know you guys have spent the last few days worrying about the weather. Over here in Europe, it is mild and it is windy. Those are perfect conditions for sustainable fuels to do their bit, for the wind turbines to work their magic, and as a result of which, we are not consuming very much gas right now. So natural gas down by over 6%, Kaylee.
All right, guys, speak for the vast majority of the American population right now in that we envy your mild weather because it has been a very cold and in many parts of the country, brutal couple of days. Now, we do want to get back to the China story. The country's decision to abandon its COVID-0 policy and reopen its borders has prompted a global response, with other countries now considering whether to test or restrict travelers from China. Bloomberg's Alan Wan joins us now from Shanghai for the details. So, Alan, what countries are we talking about and why are they considering imposing these restrictions?
Well, Japan was one of the first countries to come out and say that it's going to require PCR tests for travelers from mainland China. But other countries, such as the U.S., are also considering COVID precautions as well. The reason is because this concern that now that things are we've ended COVID-0, things are opening up and people can travel again, that there may be new variants emerging from all these people traveling from China. But the reality is that so far, I think Global Group came out with a study showing that the variant that's circulating around China is the same one that we're seeing around the world. And also you've got other countries such as India and Malaysia considering restrictions as well. But right now they look broader and not necessarily targeted at China. One concern people have been asking me is whether or not these new restrictions are going to curb travel from China. And from what I've seen so far, I would say no. Right now, bookings from mainland China to international locations are up 254% from yesterday morning compared with the previous day. And a lot of these folks still want to go to places like Japan, Malaysia, Singapore, Hong Kong, Macau. But what's interesting is that some of the folks want to travel to Macau and Hong Kong because they want to get the mRNA vaccine there. And also another thing that might also not discourage travel is the fact that we've got Chinese New Year coming up around January 21st. And the only thing that's probably going to inhibit travel are going to be high ticket prices.
Certainly something we're keeping an eye on. Meanwhile, in Hong Kong, they're due to end some of its last major COVID rules in a sweeping overhaul of policies aimed at reviving its reputation as a global financial center. Alan, stick with us. We're going to listen to some sound from the city's chief executive speaking about the shift.
I want to tell the world that, though, this is Hong Kong. Hong Kong is very normal now. And that is why it has come to the right time that we will do without the vaccination pass. And that is exactly what this government has been planning to do for normalization. It has come to a time where we don't have to rely on the vaccine pass.
At its core, the issue is one of the economic revival. Alan, I have to ask, how normal is Hong Kong right now?
Well, you might want to ask people in Hong Kong. I'm in Shanghai, but I was in Hong Kong last month, and for me it was not normal at all, especially that mask mandate. So right now, Hong Kong is going to end some of his last major COVID restrictions, and it's coming from mainland China. It's kind of surprising that Hong Kong is still extremely cautious. But as far as international travelers are concerned, when they arrive in Hong Kong, they no longer need to take 2 PCR tests upon arrival. Although it's suggested that they take a rapid test 5 days into their trip, and then when they leave Hong Kong, they need to take a PCR test within 48 hours or rapid tests within 24 hours, I believe. Two other restrictions that have been lifted as well, and these are really important for people who live in Hong Kong. One is they got rid of the vaccine mandate, so no longer need to show proof of vaccination when you go to public venues. And also, they got rid of they're scrapping limits on public gatherings, especially in restaurants and bars. But like I said, there's still one major restriction that they still haven't lifted is the mask mandate. That's something that I was surprised at when I was in Hong Kong last month. And in terms of reopening the border, that's probably not going to happen until January 10th at the earliest. That's what the SCMP is reporting based on their sources. And John Lee said that, he himself said that it's going to be a very gradual process of reopening.
Great stuff, Alan. Thank you very much. We always appreciate the updates. Bloomberg's Alan Wong joining us from Shanghai. Let's turn to what is happening with the global bond market story, which is being affected by what we've just been hearing out of China. Global debt markets extending earlier the sell-off amid concern around China reopening and the impact that that's going to have on inflation. We're starting to see yields beginning to drop back a little lower now. Let's get an update with Bloomberg's Danny Berger.
Yeah, Guy, in places like Germany, you're starting to see a sort of bid come in, but this move has been so massive, and I think it's really telling that here at the end of the year, we're not talking about a downshift coming from the Fed. It's China. That is the top concern for this macro environment and the inflationary impact that that might have. Australia reopened today. Its bond market had the first 2 days of trading off. And of course, Australia is going to be one of the markets most impacted by China since it's such a major trading partner. Yields on the 10-year, Aussie 10-year surged by 21 basis points during the trading today. But this is a global story because it's about more demand coming from China. And of course, if they're reopening, the surge in COVID cases means strains on the supply, on global shipping, things like that, concerns we had during COVID. So everything really moved higher yesterday. Germany led the sell-off. Yields there on the 10-year moved to its highest since 2011. But Guy, to your point, yes, we are seeing a little bit of bond buying, but just the whole asterisk to put on all of this, it's the last week of the year. It's been a very bad year for bonds. Weird stuff happens. Rebalancing is happening. So take all these moves with a grain of salt.
Yeah, Danny, and at its core, the BOJ playbook hasn't really changed when it comes to bond purchases, but I have to ask, how is it impacting its currency? Because that seems to be a pretty touchy point when it comes to just how successful that program is.
Right. Well, the BOJ looks at this global bond market rally that's going on, Critty, and gets concerned because they've continued to emphasize that they are having ultra easy policy. The widening of the yield curve control band, that wasn't about tightening markets. So they announced an unscheduled bond buying program today. But the other part of this, Critty, which is really to the heart of what you're asking about the movement of the yen, is they've released their minutes from that December meeting where they continue to emphasize they're not changing policy. They still want easy policy. There will not be a repeat of December. That very dovish language means that the yen is falling in today's trading versus the dollar. It's down by about 1/3 of 1%, Kaylee.
All right, Bloomberg's Danny Berger, thank you so much. Now let's head over to the world of crypto. Court papers show that FTX co-founder Sam Bankman-Fried and former FTX executive Gary Wang borrowed over $500 million from Alameda Research to buy an almost 8% stake in Robinhood. Bloomberg's Ed Ledlow joins us now for more. So Ed, it's a question now of who that stake belongs to.
Right, this is case in point for the whole FTX implosion and untangling the web of which money belongs to who and where. Caroline Ellison, who was the CEO of Alameda Research, authorized the loan to Sam Bankman-Fried for $546 million US. It was put into an entity called Emergent Fidelity Technologies, 90% of which was owned by SBF, 10% which was owned by his business partner, Gary Wang. They were used to buy the Robinhood shares. Now, according to these promissory notes and court filings which were released overnight, there are several actors trying to lay claim to this 8% stake in Robinhood. So you have FTX itself, which claims ownership of the shares. You also have BlockFi, who argue that actually Caroline Ellison, just before FTX implosion, had pledged those shares to BlockFi, which is now a bankrupt crypto lender in its own right. And then finally, you have an FTX creditor, an unnamed single FTX creditor, also trying to get hold of them. That's just one example of a tranche of money that we're trying to untangle the web and understand, all told, who actually holds it and where is it.
Let's talk more broadly.
Yeah.
As you say, the race is on now to control assets. Normally, in financial markets, if I put an asset through an exchange, I continue to own that asset.
Yes.
But in the world of crypto, that is not necessarily the case. But customers are now basically suing and saying, we should own the assets that were on exchange. They
Yes.
are ours. We put them onto the exchange. We should have control.
Not surprising that creditors are lining up to gain preferential position, right? Equity and debt investors. But this is interesting. So 4 FTX customers have sued and are seeking their suit to be converted to class action. They argue that those funds, which were customer funds, were never FTX's anyway, so they cannot go to the creditors in the first instance. They should go to the customers. It's a very straightforward argument. They argue basically that those cash and assets should be very easily traceable to the customers. The customers put them in.
Yep.
You know, FTX has a fiduciary duty to its customers to hold them, and they should go straight back. End of.
All right, a saga that is going to continue to unfold. Bloomberg's Ed Ludlow, thank you so much. Now to another corporate story we are watching this morning, Tesla. The stock's tailspin accelerated on Tuesday, falling for a 7th straight day in the longest losing streak since 2018 on a report of a plan to temporarily halt production at its China factory. The shares are now down about 69% on the year, and Tesla's market value has shrunk to roughly $345 billion, costing the company its position among the 10 highest valued in the S&P 500. And unfortunately for Tesla investors, those shares are extending their losses in pre-market trading this morning, in the red once again by about 3.3%. So a deepening of the year-to-date losses if this does continue. And interestingly, other EV makers are down in pre-market trading as well. Maybe the concerns around demand are bleeding through to some of Tesla's competitors. Rivian, Lucid Group, each down in the ballpark of 1 to 2%. And one other stock story we have continually watched over the last several days is Southwest Airlines. The disruptions from that record-breaking winter storm in the U.S. over the holiday weekend are lingering for Southwest. They say they hope the schedule will be back to normal before next week, so it could still be days of flying a reduced schedule. And analysts over at Citi say this could hit Southwest's fourth quarter results earnings by about 3 to 5%. So after a 6% drop yesterday, that stock once again down by about 1.3% before the bell today, Guy.
I would imagine passengers are looking forward to things getting back to normal fairly quickly as well, Kaylee. What are we going to do next? Hugh Roberts, Quant Insights Head of Analytics, is going to be joining us a little bit later on. We're also going to be speaking to Martin Malone, Chief Economic Advisor at Alpha Book. We'll get their take on what 2023 is going to look like. That's coming up. This is Bloomberg.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition, and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? test to make sure, you see, at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg Surveillance, the early edition. I'm Guy Johnson in London. Kriti Gupta and Kaylee Lines are both in New York. Let's talk about what's happening in the commodity market. Oil under a little bit of pressure. As everybody's been saying, it is super light volume. Take what you see on the screens with maybe a pinch of salt. But let's talk about the reopening trade in China and how it is impacting the commodity markets. To do that, we're joined on set by Eddie van der Walt, Bloomberg Markets Live Deputy Managing Editor. Eddie, let's start off. Metals equities in London higher, metals generally higher. That's the China trade. I would have thought that that would extend into the crude market as well. China lifts travel restrictions. I would have thought jet fuel would be higher. I would have thought Brent would be higher.
Yeah.
But it's not.
Right,
Why?
right. I think there's a lot of elements to the China story, right? I think number one is China reopening does not necessarily mean people will be able to travel as much as they want to because we're seeing these COVID waves and so on.
Yep.
But I think the biggest story for oil broadly and for oil products broadly is the US, right? You've got planes grounded, you've got freezing temperatures. I think that is the biggest story. If people are not driving in the US at the moment, I think that's a little bit more of a worry in the near term. But as you say, these are very thin volumes, and we won't really know what the market thinks about all of this until we get, through the first week of January.
Eddie, there's been a dynamic in the commodity market specifically where it was the ultimate kind of hedge du jour, which created a lot of macro tourism, as some people called it, into the commodity market. That has since fallen in the last couple of months. That exposure has dropped, and therefore open interest has dropped. I'm wondering if there's a pivot point that we see in 2023. What might that look like?
Yeah, Kriti, I think there's been an awful lot of tourists in commodity markets, and in commodity markets where you don't generally see them. Things like European natural gas, and I think they are very quickly looking for the exits and finding that the exits are a little bit smaller on the way out. I think if you go for a niche commodity, you've got to worry as a hedge fund that you can't get out. But that being said, commodity markets still, I think with the China reopening, are probably going to be fairly bullish going into 2023. Copper should do well. I think, commodity markets, even Brent is going to be a very, very nuanced picture. But I think if you look at the metals in particular, that's probably where the safest hedges against this new round of inflation that people seem to be worried about is to be found.
All right, Eddie van der Walt of Bloomberg Markets Live, thank you so much, as always. And for more market analysis from Eddie and the team, check out MLIV Go on your Bloomberg terminal. This is Bloomberg.
What I love about business is you get to build things from nothing. I don't have any investors. This is all money in. This is me just building it.
It's pretty much full service shadow banking with nobody in charge.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A
piece of an asteroid is a piece of the earliest beginnings of the solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Kriti Gupta in New York and Guy Johnson in London. Now keeping you up to date with news from around the world, here's the first word. In western New York, the number of fatalities has risen from that record-breaking snowstorm. At least 31 people have died. The storm dumped more than 4 feet of snow on Buffalo. Meanwhile, travel is still a nightmare for thousands booked on Southwest Airlines. The carrier has already scrapped 60% of today's flights. Some stranded travelers face days of waiting. The Biden administration will comply with the Supreme Court order that keeps in place sweeping coronavirus border controls. The court ordered that the restrictions known as Title 42 stay in effect while the lawsuit goes forward. President Biden says he'll enforce the order, but believes that lifting the measure was overdue. And Bloomberg has learned that years of Donald Trump's tax returns will be released Friday by a House committee. Key identifying information such as account numbers will be blacked out. The documents will be the first complete look at the former president's tax records for the years he was running and in the White House. Coming up, we will get back to the markets from a quantitative lens. Hugh Roberts, Quant Insight Head of Analytics, will be joining us. This is Bloomberg.
Successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question. Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
This is Bloomberg Surveillance, the early edition, and here is what you need to know. As China opens the floodgates for foreign travel, other countries say, not so fast. Japan and Taiwan reimposing testing. The US is considering a similar move, warning that things could change, quote, quickly. The yen drops as the Bank of Japan announces unscheduled bond purchases, pledging once again that yield curve control will continue. And Sam Bankman-Fried plus another executive borrowed more than $500 million from Alameda Research to fund a stake in Robinhood. The question now is, who owns those shares? We're going to talk about the latest on that story. I'm Guy Johnson in London. Kruti Gupta and Kayleigh Lyons are both in New York. Anna Edwards is off today. Matt Miller will be co-hosting Surveillance in the next hour with the one and only Kayleigh Lyons. Kruti, let's talk about how we are set up for the US market opening a little bit later on. Over here, volume's a little light.
Yeah, I'm going to say the one thing you're not supposed to say on a financial network, which is not a whole lot is happening when you look at futures. We are really seeing it unchanged this morning. It's marginally green on the screen here. You are almost just shy of 0.1% higher on futures. Once again, nothing to write home about. And it's a similar story in the 10-year yield, 382. But I think what's really interesting is that you are seeing sentiment turn to the downside a little bit. And I love to look at Bitcoin and crude for that kind of indicator. The idea here, the NYMEX crude trading at a 79 handle, by the way, down about 0.4%. And really substantiated that risk sentiment turning a little bit sour, Kayleigh, by the Bitcoin story, only down 0.2%. From a volatility context, neither one is showing any major signals. That just tells you people are either at home or asleep at the desk. Either one, pick your choice. But it kind of tells you that, once again, it is that light volume environment. It is that very thin liquidity environment. But let's see if it kind of picks up going into the new year.
Okay, for people at home or asleep on the desk, turn on the TV or turn on the radio. You can do something with your day and listen to Bloomberg Surveillance Early Edition, because even if it is quiet on the macro high level, there are some actual stories worth paying attention to on the micro level, including Tesla, which has been just fascinating to watch the deterioration in this stock. It was down 11% yesterday. Concerns around production in China and demand in China taking down the stock for an 8th day in a row, longest losing streak since 2018. It is now down 69% on the year, and it is adding to those losses this morning, down another 3%. So that alone is worthy of turning on your TV to hear us talk about. But it is dragging on other EV makers as well. Rivian and Lucid Group also both in the red in pre-market trading. And then lower for another day, Southwest Airlines only down about 0.6%, but that is following a 6% loss yesterday. They are still dealing with delays, reduced schedule after the winter storm over the Christmas weekend, Guy. And as a result, that stock is taking a pretty brutal punishment, Citi warning that it could mean a pretty significant hit to the company's fourth quarter results.
See, I'm with you both. It is incredibly quiet out there. Not as a lot is happening. But if you dig, you can find a few little nuggets to talk about. Let me walk you through the bigger picture here in Europe. Stock 600 doing absolutely nothing. Volume is super light. So at that level, nothing going on. But get into the sort of the sector story and you'll see what's happening with the basic resources, the miners. They're doing well. That's the China trade that seems to be having an effect today on the metals. What is interesting is it's not having that big an effect on the energy story, or at least the crude story, where actually the US shut-ins are probably a bigger factor. But what we are seeing over here is incredibly mild weather, and it's quite windy as well. Now, that is almost the perfect conditions for Europe at the moment. We need it to be mild so we don't have to turn the heating up very much. We need to keep the lights on, and the wind turbines are helping us do that. So natural gas here in the UK down by another 5%. I think this is the longest streak that we've had with gas moving lower sequentially since the war began, Chrissy?
Certainly something to keep an eye on. It's interesting to see what the kind of war hangover is going to be into 2023, of course, as the conflict rages on and continually fuels, I should say, inflation. But of course, joining us now to break it down, some of the impacts that we might see in 2023, Hugh Roberts, head of analytics at Quant Insight, joins us. Hugh, thank you as always for joining us this morning. I want to start with that inflationary story because it's not just the war in Ukraine that's driving prices higher. It's also the idea of a Chinese reopening. But I have to ask, in your opinion, how much does that complicate the Federal Reserve's job?
Yeah, it makes it far trickier. But you have to admit that the Fed have been consistent throughout 2022. They were arguably late to start, but they've been pretty single-minded in terms of their fight against inflation, and they have unambiguously tightened financial conditions for the first half of 2022. We have seen financial conditions come back a little bit, and I guess now that's setting us up for arguably the key debating point in the beginning of the new year, which is the Fed once again have reiterated that when they get to kind of 5.25, whatever the terminal rate ends up being, that they will stay put, that there are no rate cuts being projected for them for the next 12 months. And of course, the money markets disagree with that and have started to discount rate cuts for the second half of next year. That really, I think, is the main battleground that we will see for bond markets, currency markets, and equities.
So is essentially what you're saying, and as at Quant Insights, you use AI to essentially measure the impact of the macro environment on financial assets. Is the Fed going to be the macro story in 2023, just like it was for the entirety of 2022, or does something else come to the fore?
Absolutely. That's really the most interesting thing from our quant work at the moment. Throughout 2022, the Fed was the #1 game in town. It was all about them tightening financial conditions. And now we've got a couple of tentative signs that actually there's a regime shift unfolding underneath the surface. And we say that for a couple of reasons. One, our model confidence for US equity markets has started to fall. That means that our macro dynamics currently have started to explain less of price action in the S&P, in NASDAQ, and that's often a sign of a change in a regime. And also we're noticing a transition in terms of the key factors. So it was all about financial conditions for the last year, real yields, credit spreads, etc., strength of the dollar. And what's happening as we move into the beginning of a new year is actually real economy factors are becoming more important. We have a real GDP tracking number for the States, for China, for Eurozone. That's become more important. Industrial metals, copper, iron ore, they've become more significant drivers. So it looks like we've got fledgling signs of a bit of a regime shift away from financial conditions and towards the real economy, which will make the kind of hard versus soft landing debate probably critical.
Hugh, good morning. It's Guy. I hear what you're saying about the confidence in the model, but nevertheless, what is the model saying about mispricing?
Yeah, so at the moment, we have equities as modestly cheap, around, say, 2% below macro warranted fair value for the S&P, similar orders of magnitude for the other major indices. I think what's interesting is that the machine seems to be coming up with a bit of a barbell approach. I mean, it doesn't have a portfolio approach. It approaches each model on its own right, but it is getting bullish signals on some value stocks, some kind of energy, basic material, kind of classic cyclical plays, which would make you think, okay, maybe either the recession is delayed further or we are engineering a soft landing. But at the same time, it's also advocating bullish positions on some more defensive stocks like high dividend plays, DVY and ETF, cash cows, another ETF that tracks companies with strong balance sheets. So it seems to be a little bit of a kind of a hedged position between those two tails of the barbell.
In terms of how fat the tails are, if you look at the sort of the distribution curve, how much do you think the center of that bell curve is going to move, and how fat are the tails relative to where they would normally be, Hugh?
I think it's such a tricky year. I mean, I know we probably say that every time, and every guest you get probably says the same kind of thing. But you know, away from the states and the central bank reaction function and the strength or not of the real economy, really it's the topic that you guys were talking about beforehand in terms of China and how you're supposed to legislate for a bumpy reopening in China. Clearly, we all hope it's long-term positive for Chinese growth, global growth. That might, if it gets out of hand, have implications for demand for commodities and therefore the fight against inflation. But equally, it does seem to be an extremely bumpy reopening in terms of just the ability of the Chinese health authorities to cope, the increase in cases and deaths, sadly. And that could actually mean that we're going to see a reopening from a central command perspective, but actually will it change the mass population's economic behavior? So trying to legislate that from a behavioral discretionary perspective or indeed from a quant modeling perspective is just so tricky.
Well, Hugh, as we start to see these reopening steps, this kind of idea of one step forward, potentially two steps backwards that we have seen in the last couple of months from China, does that create a little bit more confidence in investing in China? What do you think?
So I think this is one where it's a classic kind of risk-reward in the sense that our models were out of regime for a long time for Chinese equity markets. That was a function, obviously, Beijing and politics being more important than macro fundamentals. Our shorter-term models did pick up towards the end of last year and suggested some upside, but have now kind of leveled off and are kind of flatlining once again. I think it's really about the politics still. So trying to kind of work out from a pure quant perspective is tricky. But the chart you're showing at the moment is very interesting from our perspective because we use dollar yuan as an input. So the FX is kind of FX markets portrayal of what they think the health of China is. And that's a key input across a lot of assets, including equities. And that has emerged as the critical driver. So I guess one big takeaway from our side would be that equity people who tend to focus on company fundamentals tend to be looking at bottom-up analysis. They really need to be watching currency markets and dollar yuan in particular. It's a key indicator.
All right, Hugh Roberts of Quant Insight, thank you so much for joining us. And coming up, we'll continue the China conversation, talk about perhaps the positive implications for growth, but the potential negative implications for inflation. Martin Malone, Chief Economic Advisor at AlphaBook, joins next. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
They've raised their inflation forecast.
Firm and immediate action.
He wants to destroy my country.
Elon Musk to buy Twitter.
Overturned Roe versus Wade.
Boris Johnson will call it
Donald Trump's plan to overturn the
unprecedented search warrant at the home of our former president.
Queen Elizabeth has died.
Xi Jinping got his third consecutive term.
Pound falls to an all-time low.
The shortest ever serving prime minister.
Presidents Biden and Xi shake hands.
FTX filed for bankruptcy.
The red wave that never was.
Protesting his zero COVID policy.
right, let's get back to
China is not as clearly a black and white story as it used to be, which is if China's growing, that helps the world economy. Now there's a lot of shades of gray in that story, and that's what bears watching.
That was Steve Sosnick, Chief Strategist at Interactive Brokers, talking about the China reopening story. Joining us now for the other factors facing the global economy in the year ahead is Martin Malone. He is Chief Economic Advisor at Alpha Book. Martin, great to speak with you. If we could just start with China, because that is what has really driven the news flow over the last several days. On the one hand, there may be reason for optimism on the global growth story, but there seems to be growing concern about the implications for inflation. How do you expect China's reopening could alter that trajectory in the year ahead?
I don't think it's going to add to inflation because basically we have an excess property situation in China. We have an excess labor market situation. So the youth unemployment in China is 20%, and it's under 10% in the advanced economies. So China's job is to dramatically ease monetary and fiscal policy like we've seen in the last 6 months, and they're going to continue that policy throughout 2023. China has a large number of domestic problems which can only be solved by actually creating some sort of boom-type dynamics in 2023, and that's going to be good for the rest of the world.
Good for the rest of the world, good for China. How would you stack up Chinese assets versus rest of the world assets?
Well, we went max long Chinese property 3 months ago, and everybody thought we were crazy. And I think that's delivered around 30-40% return, depending. You can play that in the bond space and the equity space. But I think the main factor of China is that the political events are now all over. They're getting a very, very cheaper energy input compared to advanced economies from the likes of Russia and Venezuela. And they've got a huge level of advantages because their interest rates are actually declining, whereas the rest of the world's interest rates are actually surging. So it's one of the only countries in the world that are actually easing macro policy.
Martin, has the easy money been made on that trade? I say easy. You had to make, obviously, a fairly big call on it. But are you going to lighten up on that position? Do you think, in terms of where the opportunities lie globally, China's had a big leg up? Do you think you're going to redeploy some of those assets elsewhere?
Not at all. It's very difficult to trade China. So other ways to trade it, for instance, we are extremely bullish Japanese stocks. We're very, very bullish the Aussie dollar. And obviously, some of the commodities that China will need on a reopening. It's not like an 08, 09, 10 boom period for China where they're going to actually just build because they have an excess supply of property. But their property market's going to do very well. The level of imports that they will need on the commodity space will be a lot lower than what they've previously taken in. So I don't expect a commodity boom. I don't expect an inflation response from a solid Chinese economic growth story in 2023. It's just a very, very good factor when we've got the advanced economies having a recession in 23.
But Martin, how much of that is actually priced in? It feels like the carnage you've seen in the equity markets on both sides of the Atlantic has priced in a recession already. So does that actually create some sort of bull case for American stocks or European stocks for that matter?
We're actually very bullish for US stocks. Actually, there's an 85% probability that we could get a 20% return in US stocks in 2023. But we have to factor in that we've had dramatic concentration risk during the 3 years of the pandemic. So the top 6 stocks were the star performers. America was the star performer. And this setback that we've seen in the last 12 months is very much related to concentration risk imploding, because most of the world's investors are just passive players and they're just basically playing catch up each quarter to the price action. And those will continue to lag price performance as we go forward. But recessions are actually bullish. And that's the case of all recessions except 2 the 1974 and 2002 recessions. But overall, our case is the recession in America is a bullish case for stocks, not a bearish case.
And how does the currency picture factor into that as we start to see more kind of calls for weakness in the greenback? Is that meant to be a tailwind for U.S. stocks, just given the negative correlation, or is that meant to be kind of a canary in the coal mine that maybe U.S. stocks don't actually have that much room to run?
The currency trade actually was very, very easy because we had this, the Fed made a dramatic mistake in 2021 by refusing to hike interest rates. But the markets hiked for them in 2021. In 2022, the Fed hiked over 400 basis points. That's never happened before. The Volcker period, they didn't actually use interest rates, they used reserves as their main tool. We've never seen the Fed hike 400 basis points in 1 year. So they played dramatic catch-up. So it was very easy for the dollar to rally in such a scenario. But now we have peak rates, we've got peak inflation, and we've got peak dollar. It doesn't mean the dollar rally is over. We've just basically taken a pause. And the pause period is actually very, very good tailwind for corporate earnings in America.
Martin, thank you very much indeed. Martin Malone of Alpha Book. Have a very happy new year as well. Coming up, Adam Posen thinks inflation will be trending faster in 2023. A little controversial, part of our interview with the Peterson Institute president next. This is Bloomberg.
Was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
I've
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Guy Johnson in London. Anna Edwards is off and Kaylee Lyons joining Matt Miller for surveillance in the next hour. Investors are hoping for a slower pace of inflation in 2023, but just how far and fast will it fall? David Weston spoke with Peterson Institute President Adam Posen about his expectations for the year ahead. Take a listen.
I think we will. David, thank you for having me during this holiday week. And actually, my views are similar to the ones Peggy was just saying, drawing on the Bloomberg economics team, a little different. But basically, I think by the time we get to a year from now, inflation is going to be clearly starting with a 3 handle, and that it's going to be clearly trending down. The issue is going to be how much more than 5.25 in February the Fed's going to have to raise, and then how much are we going to accelerate getting from 3.3, say, down to 2? Those are the questions. But I think the getting from the high inflation we are now towards 3 is pretty much baked in.
And Adam, in anticipating that favorable development, however far it goes, part of the question I guess I have is what's going to cause that? Because on the one hand, it could be improving supply chain situations. There have been some indications that is improving some, the way we were told it would. How much of it is the Fed tightening?
I think it's mostly the Fed tightening. When I talk about inflation, David, I'm being a little sloppy. What I really care about is the trend or various measures of core. The Fed Open Market Committee, of course, looks at core PCE as a particular measure. I think what's important to understand is that wage inflation out of step with productivity growth is the big trend driver, even if it's lower than the rate of actual inflation, meaning a lot of workers are seeing real wage declines. That's ultimately where you see this going on. A lot of the favorable supply developments you mentioned are already in the mix, and the only thing that hasn't been fully priced in yet I shouldn't say the only thing, but the only major thing is rents, because rents are going to be coming down in line with housing prices, probably, but the rent indicators are lagging. So if we see inflation coming down further or faster in 2023, it's going to be because of Fed tightening.
That was Peterson Institute President Adam Posen speaking to Bloomberg's very own David Weston. Guy, you know, it's interesting the point that he's making here, that inflation is going to come down, but now that the focus here is shifting from the commodity inflation, shifting from the housing market into the labor market, that wage price spiral is still very much a theme.
We don't get much data this week, but we do get claims, so that could be one data point to watch out for. I just wonder how this storm is going to factor into all the data as well. That's going to be something that I think is going to challenge economists. Kriti, great coverage today. It continues next. Surveillance is ahead. Kaylee Lyons and Matt Miller. It's going to be a great show. This is Bloomberg.
To name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city, it's a symbol of a nation, it incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
We've flipped to good news is good news and bad news is bad news.
The worst won't happen by the end of the year. It'll happen somewhere in the middle of the year.
Expectations need to come down, right? So we've had an incredible run.
There's a lot of opportunity for positive surprises.
We're getting back into a more normal zone of consumer price sensitivity, and that's really key.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York City, for our audience worldwide, good morning. This is Bloomberg Surveillance alongside Matt Miller. I'm Kaylee Lyons. We're in for John, Tom, and Lisa this week, although I think Lisa's coming back tomorrow, and she's missed reportedly. She's missed a relatively quiet couple of days, volume really light. It is the holiday week after.
Yeah, I mean, I've actually just read from a trader that there are a lot of orders in on the S&P this morning, so we should pay close attention to that, and I'm sure Lisa, wherever she is paying close attention to that. The question is, will she be able to get back? Assuming she's an airplane away from us right now, it could be pretty difficult because the travel chaos continues.
Especially for Southwest Airlines. They are flying a reduced schedule again today. They plan to do so in the coming days. The company's CEO said he thinks things will be back to normal before next week, which if you're currently stranded at an airport somewhere, probably isn't really what you want to hear.
Unless you're stranded in a great place. For example, my brothers had their flights canceled in Jamaica. And, you know, they were scrambling to rebook, but I thought, why? Why not just stay?
That sounds much better than the cold we've been dealing with here on the East Coast for several days now. Now, while we're talking about traveling and flights, did you see the latest data out of China? After the news that they are no longer going to require quarantine for inbound travelers, bookings were up something like 254% for travel out of China. The question is, can those Chinese travelers actually arrive into other countries? Because we're seeing some restrictions being put into place because of concerns around new variants.
Yeah, and we were talking yesterday about would the demand be there to travel into China. I hadn't even thought about the fact that there could be an exodus out. Maybe they're concerned that China will go back to a COVID zero policy. Maybe they don't feel comfortable for other reasons. Maybe it's just been so long that they want to get out and take a vacation like everybody here did after we reopened. Nonetheless, that's really interesting data going in the opposite direction than I had expected.
Yeah, I think it probably is that revenge travel that the rest of the world already got out of our systems. I know I've done a lot of it in the last 2 years, but for those living in China, it's been really, really difficult to do for several years now. So maybe all that pent-up demand is what is coming to the fore now. Let's get a quick check on the markets because, of course, China initially had a very positive impact on the equity markets yesterday, but that rally did fade into the close. This morning has been a little bit wishy-washy, but at the moment we are positive on S&P 500 futures by about 0.25%, right around the 38.64 level. So still, we remain below the average year-end target with just about 3 trading days to go in 2022. In the bond market, of course, is where we saw massive moves yesterday. The 10-year Treasury yield really leading a surge upward in yields around the world. Overnight in Australia, Matt, the 10-year yield was up 21 basis points. But interesting today to see the 10-year here in the States coming down about 2 basis points, but still at 382. That is much higher than we were at this time last week.
Yeah, and if you look overseas, our friends trading early this morning are watching the Italian BTPs. Those spreads from bonds are out to 211. Now, I think we need to wait until they get to 300 basis points before we really start to worry about what's going on in Italy. But the situation in Europe, of course, very different than what we're looking at here. You saw oil there as well, trading at $78 and change. That's for NYMEX crude. I was looking at the BCOM index today, the Bloomberg Commodities Index, to see how far up we've shot since the reopening of China. And the interesting thing is not at all. We haven't really moved higher on the BCOM index. So although you'd expect a reopening in China to drive growth, to drive demand for commodities, we have seen here and there prices tick up. But if you look across the commodities sector, you just really don't see a takeoff from the levels that we've seen over the past few weeks and months.
Yeah, definitely not the kind of behavior you would think China would inspire. So let's get another take on this now. Ben Emmons, Principal and Senior Portfolio Manager at New Edge Wealth, is joining us. Ben, how are you thinking about the China reopening story? How does it influence your expectations for markets across asset classes in the year ahead?
Good morning, Gillian and Matt. Great to be on. I do think it's a major macro event. As you actually described at the start of the segment, the bookings up are 200%. The Chinese coming out of China, going, traveling, as much as the restrictions will be put in place. This tourism, I think, is one of the factors that will drive activity globally. Top of my head, there was at least counted for a few $100 billion annually that Chinese tourism caused in terms of global activity. Doesn't sound like much, but I do think that can be impactful. And as you say, like the anticipation of this reopening, it is slowly being priced in. The metals index is, for example, one that has actually perked up a bit. And you can tell from, for example, Australian bonds, they were up like 20 basis points overnight. That's an example of a country that will be directly impacted by China reopening the quickest. And their expectations for rate hikes, which initially were priced at a pause, are perking up again to potentially a hike. So I do think markets are getting ready that this is a macro factor, macro event for 2023 and could impact expectations for inflation.
So, well, first of all, Merry Christmas to you, Ben. I haven't seen you since then, and Happy New Year if I don't see you before the end of the fish run at MSG. I had been debating with a lot of guests over the past few weeks, does a reopening in China, does a reversal of the COVID zero policy, does that bode well for global growth and markets as you would expect, as you've been saying, or is it more of a concern if the disease spreads rampantly and causes massive amounts of fatalities in China? It seemed to be up for debate. Have we decided now that it's good for global growth, that it's good for markets, good for commodities prices? And can you get ahead of that trade now by buying into the year end?
Yeah, I would be more on the latter, I should say. Like the markets seem to be pricing that this will be, let's say, a relatively positive catalyst for global growth. And there's a lot of pessimism out there that we are going to hit a recession next year in the United States, and we are already in a recession in Europe. That's a strong expectation. So this China reopening is weighing against those expectations. Yet, as you say, there's a risk that as the borders in China open, there will be virus spread globally, and there could be new variants, and it could cause to some disruptions. But we have to also take, at least stock and faith into the vaccinations that we've had here and elsewhere, that disruption will be less than what we've had in the past. So the markets seem to be more leaning, I am too, leaning to that it will be a positive growth catalyst, or at least weighing against the recession expectations. So I think you can buy into an extent. That means that you could have some international exposure. I think Asia is, for example, an opportunity, because that's still the region that has been lagging the most against the other regions in terms of the reopening play. That's still, I think, the last one, but it's still there that you can trade.
Since December 1st, Ben, we've come down from about 4,100 on the S&P 500 to 3,829 at the close yesterday. And typically, traders talk about or expect a Santa Claus rally, not these kind of drops. However, you noted to one of our producers that 50 years ago in the Stock Traders Almanac, a Santa Claus rally was all about the last 5 days of the trading year and the first 2 days of the following year. Is it still like that? Do you think we could have it? And does it bode well for 2023 if we get it?
It may be possible, Matt, as in that the China reopening is the story currently to maybe drive that Santa Claus rally. And yes, it is the 5 days the last 5 days of the year into the first 2 days of next year. And then there is that January effect too. It's technical analysis, but it seems to be having a seasonal historical relevance. I would note there too, though, that bonds are seasonal too during this time. Typically, bond yields decline in the month of December. They're now up. So I think the combination of that, of rising yields, expectations of China affecting global growth positively, yeah, you could eke out a mini Santa Claus rally, if you will. Let's see what happens in the next few days.
On the subject of bonds, with that upward pressure on yields we saw around the world, the Bank of Japan decided to show up once again with unannounced bond purchases. Even though they did make some tweaks to yield curve control, raised that cap, they're still conducting yield curve control. How much pressure do you think will be on Kuroda in the first few months of the year, and then whoever takes over after that, to abandon that policy entirely if we do see these inflationary pressures more persistent?
Yeah, I think, Kaylee, that Kuroda has basically laid out the path to abandon yield curve control policy altogether, meaning, you know, he was and he is the most, let's say, creative and extreme monetary policy maker ever, right? I mean, he has applied everything that you can apply in terms of monetary easing. So for him to do this unexpected move before he gets out of office, and recognizing that inflation is rising in Japan and that it could lead to a different environment than this protracted deflation that he was always very worried about, I think politically has moved the possibility of you can leave the yield curve control now completely out of the bond market and start thinking about raising the policy rate to positive at least. And that's what the market, I think, is anticipating. You know, the 2-year yield in Japan is now positive. Overnight, the 2-year auction for Japanese government bonds was poorly received. So I do think that there is an expectation that yield curve control will be a policy from the past. And I think Kuroda has just set it up. So this new governor that comes in probably will make that move pretty soon in the spring to abandon the policy.
All right, well, at least on the day, the Japanese yen weaker against the U.S. dollar. We're at 133.80 right now. Ben Emmons of New Edge Wealth, thank you so much for joining us. And of course, that yen story is not limited to today, Matt. I just pulled up the WCRS function on the Bloomberg terminal. Far and away, the worst performing currency in G10 against the dollar this year, down 14%. I mean, that is
even
remarkable.
After the massive recovery, right? I remember the days of you telling me, hey, the yen's at 146, the yen's at 145. So even that kind of recovery hasn't helped. I, by the way, want to recommend Ben's research to all of our viewers. I can't say enough about Ben Emmons at New Edge talking to us in these notes that are not only readable and understandable for the layperson like me, but also he takes a position. He makes a call, and he includes a lot of charts, and I think it's really helpful research if you're investing in these markets.
Yeah, if you have a Bloomberg terminal. Check it out for sure.
Yeah,
and
well,
otherwise
that's
well.
Obviously the basic package. And then you add options like Ben Emmons' research. Really important stuff. And I just think he walks you through Wall Street the way you need to be every morning. So
yeah, and of course, we tried to do the same, but in a different way, perhaps, than Ben. We're going to continue walking you through these markets as we get closer to the opening bell here in New York. Futures are positive by about 0.2%, and we will continue our markets conversation coming up in the next hour at 7 a.m. Eastern Time. Catherine Rooney-Vera, head of research and strategy at Baltic, will be joining us. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Rishika Gupta. China's decision to abandon its COVID-0 policy and reopen its borders has prompted a global response. Countries are considering whether to test or restrict travelers from China. Beijing's policy reversal has triggered nationwide COVID outbreaks. Both the US and Japan are weighing new restrictions on people arriving from China. In western New York, the number of fatalities has risen from that record-breaking snowstorm. At least 31 people have died. The storm dumped more than 4 feet of snow on Buffalo. Meanwhile, travel is still a nightmare for thousands booked on Southwest Airlines. The carrier has already scrapped 60% of today's flights. Some stranded travelers face days of waiting. The Vatican says that retired Pope Benedict's health is getting worse and that Pope Francis has gone to visit him. No word on what his illness is. Benedict is 95 and served as head of the Roman Catholic Church for almost 8 years. In 2013, he became the first pope in 600 years to step down. The Biden administration will comply with the Supreme Court order that keeps in place sweeping coronavirus border controls. The court ordered that the restrictions known as Title 42 stay in effect whilst a lawsuit goes ahead. President Biden says he'll enforce the order but believes that lifting the measure was overdue. Bloomberg's learned that years of Donald Trump's tax returns will be released Friday by a House committee. Key identifying information, such as account numbers, will be blacked out. The documents will be the first complete look at the former president's tax records for the years he was running and in the White House. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority. From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
They've raised their inflation forecast.
Firm and immediate action.
He wants to destroy my country.
Elon Musk to buy Twitter.
Overturned Roe versus Wade.
Boris Johnson will call it
Donald Trump's plan to overturn the
unprecedented search warrant at the home of our former president.
Queen Elizabeth has died.
Xi Jinping got his third consecutive term.
Pound falls to an all-time low.
The shortest ever serving prime minister.
Presidents Biden and Xi shake hands.
FTX filed for bankruptcy.
The red wave that never was.
Protesting his zero COVID policy.
Very normal now, and that is why it has come to the right time that we will do without the vaccination pass. And that is exactly what this government has been planning to do for normalization. It has come to a time where we don't have to rely on the vaccine pass.
That was John Lee, Hong Kong chief executive, as Hong Kong lifts some of the last remaining COVID restrictions. We continue to get that reopening news out of China and its surrounding region, but that is not seeming to lift risk sentiment, at least in U.S. markets. We did see a little bit of a lift for the Hang Seng overnight, but this morning U.S. futures are only modestly in positive territory by a little more than 0.1%, 38.61 where we currently trade. Of course, a little bit of a rebound from losses yesterday. Yesterday, though, arguably was more about the bond market. We saw the 10-year yield rocketing higher. We come in just a touch this morning, about a basis point or so, to 382 on the 10-year Treasury yield. And interestingly, despite the reopening of China and the story there, oil is not getting a bid. WTI crude right now, Matt, down by a full percentage point, 78.74 a barrel, where we are on the NYMEX.
It's really the big tech stocks that I think are most notable, though. You and I were talking about Tesla this morning, and it's difficult not to use profanity when talking about these drops. I mean, unbelievable. Lost another 11% yesterday. The stock just continues to get decimated, and it's down now. If we drop in the cash session, 8 days in a row, the longest losing streak since the IPO.
Yeah, it's absolutely brutal. Interestingly, at least right now in the pre-market, after being lower by more than 3% earlier, we now are positive on the stock by about 2.5%. But we'll see if it sticks, because as you say, it has been absolutely brutal for this stock really over the course of the year. It's already down 69% in 2022. Its market value is now less than $350 billion after starting the year as a $1 trillion company. And of course, the China story, Matt, plays in pretty significantly, because what led that 11% decline yesterday and what has led to a lot of the deterioration in sentiment around this stock in recent weeks is concern about demand in the China market and what production at their factory in Shanghai is looking like.
Well, and a lot of it has to do with Elon Musk and his behavior and his purchase of Twitter. And maybe he's pushed for this, as though 69% drop is a kind of a meme drop in the stock world. He's into that kind of thing. He bought Twitter for $54.20.
And he sold a lot of Tesla stock in order to do so.
It's really interesting, but it's not the only tech stock that's losing. Apple, I just heard on the radio this morning, down to the lowest level since June of 2021 on concern about iPhone demand. So it's not just worries about people buying Teslas, although that's obviously much more oversized. You don't see a drop of that size in Apple stock, but it's down to $130 a share.
Yeah, and the China market and demand there in particular is what's really crucial to both of those companies. The question now is, as China reopens, once you get past the surge in COVID cases that is currently underway, do you start to see that demand recovery taking shape for these companies?
Let's talk about that reopening right now. Alan Wan is sitting by in Shanghai for us. Alan, great to get you again today. I know you've had a long day of covering this reopening, and the news just keeps coming in. Give us the latest. Kaylee was talking about, revenge travel. People finally allowed to go on vacation are booking flights like crazy.
Yeah, I mean, these restrictions. I mean, Japan became one of the first countries to require that mainland Chinese visitors produce negative test results upon arrival. But other countries, such as the U.S., are considering COVID precautions as well.
Uh-oh, Matt, it looks like we are having a little bit of difficulty with Alan's connection from all the way over in Shanghai. But of course, he has been, as you say, covering this story all day. So we'll wait for Alan to get resettled there. But just to put some numbers around that demand travel story.
I think he was buffering.
Buffering.
Yeah.
Buffering. That's a good word to describe it. Trip.com saying holiday bookings for outbound flights from mainland China jumped 254% Tuesday morning from the day before. That is just stunning. The question now is there going to be demand to go into China, or is it mostly going to be the domestic population going out and coming back?
I mean, that was initially my question yesterday when I saw that they'd raised the cap, or they're preparing to on January 8th, raise the cap on international flights. I thought, how many people are now going to fly in, as in, U.S. business people going over there to do deals, which they have had a difficult time doing over the last 3 years. But of course, you have to think about the people that have been trapped, who want to get out. And I hadn't thought about that. It makes perfect sense upon reflection that you'd want to book a trip as soon as you could, right? You haven't spent your travel money over the last 3 years, and now that you can, you're probably looking to book a flight to any place that's warm. We were talking with Alan Wan in Shanghai. He's been covering this reopening pretty much 24/7 since the headlines started rolling across post-Christmas. And it's interesting because, just a couple of weeks ago, we had these protests, the likes of which we found very surprising. You don't expect Chinese citizens to come out and protest that severely against government restrictions, and yet they did. The government seems to have answered by saying, okay, no problem. COVID zero reversed, which begs the question, will the Chinese continue to protest? Will they use their newfound power for other policies?
I guess it raises a question of how far the Communist Party is realistically willing to let this go. But we have to consider that there is serious economic incentive for Xi Jinping and for Beijing largely to reopen the economy, because China used to be the growth engine of the world. It has really suffered. That 5% growth target for this year, clearly unachievable given so many pockets of the economy were locked down for so long. For 2022, they'd like to achieve it in 2023, and maybe there was just a realization that in order to do so, you were going to have to unleash your citizens.
Yeah, and I think Bloomberg Economics actually estimates they will achieve that in 2023. Of course, with the volatility that we've seen over the course of these last few years, the possibility of black or gray or even white swans has to be huge, right? So you've got to take that forecast, I guess, with a grain of salt, especially if we're looking at a global recession. Clearly, we're going to, if we're not already in a recession in Europe, see a contraction in growth there. And the question, I think, now is what kind of recession do we see in the U.S.?
All right, and I understand we do now have Alan Wan on the phone in Shanghai. Alan, thanks for dealing with our technical issues for us. So we were just, he's actually, I see you. You're not just on the phone. Thank you so much. Matt and I were just continuing the conversation on the idea of revenge travel, the restrictions now, though, being put into place by other countries. Can you just walk us through what the latest is, especially because Hong Kong is now making its own moves?
That's right, exactly. Well, let me just go back to what I was saying before about Japan. Became the first major country to announce these restrictions. Basically, they were going to require that mainland Chinese travelers produce negative test results, COVID test results upon arrival. And other countries are considering the same thing now, including the U.S. The U.S. is considering COVID precautions, mainly because it's concerned about the lack of data transparency in China. And also there's concern now that China is opening up the floodgates, that there are going to be a lot of these Omicron variants floating around, spreading more variants. But the reality is that a recent study showed that the variants that are circulating in China are actually similar to what we're seeing around the world. And other countries like Malaysia and India are also considering restrictions as well, but more broad-based. Taiwan is considering testing mainland Chinese travelers upon arrival. And one Philippine minister said that they want to consider curbs on Chinese travels as well. One interesting thing is I asked my friends about this, what they thought about this. Some of my Chinese friends here, and they seemed to be offended and worried that if they they go to Japan, for example, they may be quarantined for a week. But it's still it's better than what's been going on over the last 3 years. I mean, they really want to travel, especially with Chinese New Year coming up.
All right, that coming up very quickly in January. Alan Wan, thank you so much for your continued reporting on this throughout the day. Please get some rest. We, though, won't be getting rest for the next couple hours. We will be here with you on surveillance, covering these markets as we get closer to the opening bell. We are so pumped. Right now, S&P 500 futures up about 0.2%. This is Bloomberg.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
3 days. That is how much trading is left for the year of 2022. Being a holiday week, volume may be a little bit lighter than normal, but I trust Kriti Gupta is tracking all of that for us, and she is joining us now with a market check. Kriti?
Yeah, Kaylee, a little bit more green on the screen than we saw during early edition, I have to say. You are seeing a little bit more conviction, so you are seeing futures higher, just about 0.2%. Once again, nothing to write home about. Still extremely low volume. Even in the Russell 2000 futures, you are only seeing it up about 0.2%. A little bit more gains across the Atlantic, so I wonder how much of this is going to be a volume story at the end of the day. Perhaps a little bit more conviction as we get closer to the opening bell. Stocks 600 up only about 0.4%. I have to say, what has changed the narrative, I want to say in the last hour or so, has really been the dollar. And that's really where you want to look at the intraday moves for the greenback here, because it is starting to slide just a little bit. And that weakness is actually corresponding into some strength into some of the commodity currencies. Think the Australian dollar, think the New Zealand dollar as well, even the Canadian dollar, weaker across all of the G10 currencies, is, of course, with the exception being the Japanese yen, that of course coming off the BOJ bond purchases. But when you think of that bid into commodity currencies, you would think that means the commodity complex is higher as well. Kaylee, Matt, that is not the case today. In fact, you actually see Brent crude and gold, for example, actually declining, which is interesting because it's coming as the dollar is getting weaker and weaker. Typically, those are inverse correlations. So Brent crude trading with an 83 handle, down about 0.8%. Copper is the interesting one. It's the anomaly in the commodity complex, about higher, about 0.3%. And once again, that really is just a continuation of the China reopening story that's really creating that bid into copper despite the low volume there as well. And of course, gold is down about 0.5%. Once again, following the move lower that you're seeing across commodities broadly.
Pretty amazing to me that the pound has managed to climb more than 20% since the mini budget. Remember, that dropped the pound below parity, and right now we're seeing it at $1.20, almost $1.21. So, you know, that's only been like 3 months. And Kriti mentions the dollar weakness. Obviously, when the dollar drops, you know, at least this year, that's been great for risk assets, and that's what's turned around the market today. But when she said that, I just looked across the other currencies, the euro at 106, the pound at 121. It really surprised me that we've seen that kind of, you know, gaining by a fifth in 3 months. That's crazy for a developed world currency.
Well, all it took for the UK was a total leadership change and a reversal of all of those policies, right? It didn't necessarily happen naturally. Also, Kriti Gupta, thank you for that market check. Matt just kind of decided to move on.
Well, no, I thought I was talking to her, and then I see in our little internal chat that she's clear, so she's left the room, so she clearly can't answer me.
This is the sausage making of TV, everyone. No, but Matt, you make a really good point on the recovery we have seen in so many other G10 currencies, which raises the question of if the dollar peak really is in, because of course it has been a phenomenal year for the dollar. The rate differential story, really what was driving that for so long, but now you have other central banks around the world playing catch up, and more conviction in this market that the Federal Reserve is going to change course at some point in 2023, even if they say, no, we aren't.
Yeah, and it does look like the dollar peak at 1253 on the Bloomberg Dollar Index came right at the end of September, right when we got that mini budget out of the UK. So that's when you saw the pound come below parity on September 21st, September 23rd, around there. That's when we saw the dollar peak as well. And since then, it's just been a reversal for the greenback as well as the pound and the entire UK government, as you point out. Although it's still a Tory government.
This is true. I can't believe that only happened 3 months ago, and that was just one of the borderline cataclysmic market events of the year. There was the pound, there was the yen at one point, as we discussed earlier. I mean, and that's just in FX. There have been so many just remarkable market-shaking instances over the course of 2022. It's incredible.
I'm glad you bring that up. It's a polycrisis, as our next guest puts it. Let's bring in Ivy Jack, Co-Chief Investment Officer at North Star Asset Management. And Ivy, great to have you. Thanks so much for joining us this morning. As Kaylee points out, we've seen so many crises, from the currency crisis and the fixed income problem in the UK as a result of that mini budget. But of course, the war in Ukraine has to stand out in 2022, the pandemic over the last few years. Now we're heading for, at least most people think, a recession, a global growth recession. How do you deal as an investor at North Star, and I know you're focused on ESG investing, with these crises, because all of them lead to kind of a rethink of energy policy?
Yes, first of all, thank you, folks, for having me here. I want to step back and say, I think kind of what differentiates us at North Star in terms of how we kind of think about the current situation is that we do look at it in a holistic perspective. So in terms of a polycrisis, we're confronting several challenges that are interlinked that pose a serious threat to humanity. So yes, I am certainly still concerned about some, certain items such as the war in Ukraine. Yes, I am concerned about the fact that, we don't have what I would consider a well thought out plan to transition to renewable energy. And yes, I am concerned also about the fact that, in terms of our relationship with China and the geopolitical risks that are currently present right now, kind of what that means for our economy going forward. So while we're concerned about all of those things, I think it's really important to step back and kind of look at how all of these things to a certain degree are interrelated and kind of what that means. And what that really means is that when you look at the risk of the whole is much greater than the risk of the sum of the parts. And so that is really the way we kind of approach, I think, thinking about how we are going to position our portfolio over the next couple of years, is thinking about it in the sense that, yes, there might be one or two things that might go right next year. Yes, maybe the Fed decides to stop raising interest rates, but there's so many other things that we have to focus on with respect to managing risk.
Okay, so talking of how you position your portfolio to hedge against that risk, what does that actually look like in reality, Ivy?
So for us, what that really looks like is owning quality stocks, stocks that we know well. We are not frequent traders. We also look for consistent earnings. We're currently focused on stocks right now where there's strong cash flow and strong cash flow coming immediately. And we also look for good management teams as well. So with that being said, like I said, I think quality best encapsulates what we are kind of looking for right now.
Well, Ivy, as you talk about cash flow and earnings, the ones that have been raking it in this year are energy companies, which comes back to your point about a revival of fossil fuel for a world that was supposed to be transitioning with a goal of reaching net zero. The war in Ukraine, especially the energy crisis in Europe, has driven everyone back to those legacy fuels. How do you think about that in a portfolio where you are trying to prioritize ESG strategies, but at the same time, all the profit has been accrued?
Yeah, well, first I'll say we have a fund that's fossil free. So our clients understand what's happening. We're in constant communication with them about these issues, I think also, which is somewhat unique. And so, yes, you're right. Fossil fuel is up, but we all know, again, when I started off and I was talking about the polycrisis, that if we don't figure out a way to address climate change in a fairly quick order, that there is a serious threat to humanity. So our clients understand that. And so they are more than willing to not profit from oil and gas right now. So for us, it's really not a consideration. And from a diversification perspective, you can still be highly diversified without owning fossil fuels.
All right, I think it's an important message, Ivy, that we don't hear very often on this channel, as so many investors are focused solely on profit. So I think it's really interesting to hear you say that. Also thought it was interesting to hear you suggest that the Fed could stop raising rates. Of course, that's what this market is hoping for broadly. But what's your view, also from an ESG perspective, on inflation, right? It's been very difficult, and it's been one of the problems for the transition to cleaner energy or renewable energy. This inflation has really driven us back to fossil fuels. How do you weigh the benefits of, the Fed policy versus the inflation that's put us here?
Good question. I would say, in terms of the energy crisis, we don't have a well thought out plan in terms of transitioning. So some of the uncertainty is expected, and I think going forward we're going to continue to see this type of uncertainty. I mean, I will tell you, anybody who was looking at the situation at the beginning of 2022, we did not see the war in Ukraine coming. And we did not see the challenges that Europe would have in terms of securing enough energy. So with that being said, I think we're going to continue to have a lot of unexpected events regarding energy over the next few years. And so again, we are dealing with it the best that we can.
Well, and Ivy, as you allude to with there not being a clear plan, so much of it comes down to policy. And on the subject of policy, a week from now, we will have a new Congress in session with a Republican-controlled House. And we have seen pushback on the part of some Republican lawmakers on the idea of ESG strategies. So I'm wondering how you navigate that kind of political uncertainty as well when you are thinking about how to put together an ESG portfolio.
Well, again, fortunately for us, this is not something that we have to be concerned with. But I think overall, it's just very troubling. Let me be clear in saying there's a strain of anti-intellectualism running through this argument. Because when you think of what ESG really is, you're just considering non-traditional factors. I mean, I think most investors would agree that their clients want them to be well-informed. So it doesn't make any sense really to say that, you shouldn't look at all the available data that you possibly can when making decisions. So again, for us, our clients they support the strategy that we have. I mean, we're constantly having communications with them about all of these issues. So it's not really a problem. But I think overall, it is a problem because, again, whether we like it or not, there is scientific evidence that climate is changing. We just know that also that in terms of nature, we are consuming more resources quicker than they can be regenerated. And that leads a whole host of negative impacts from, harvest, not having enough food, deforestation, even more extreme events. So with that being said, like I said, this is very troubling because there will be people who will continue to lose their lives.
Right. We have seen so much of that borne out over the course of this year. Ivy Jack, bringing the intellectualism this morning. Thank you so much for joining us from North Star Asset Management. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Rishika Gupta. Stranded travelers in the US could face days of waiting to get to their destinations if they're booked on Southwest Airlines. The carrier has already scrapped 60% of its flights today and about 20% of tomorrow's. Meanwhile, in western New York, the death toll has risen to 31 from that record-breaking storm. The city of Buffalo is digging out for more than 4 feet of snow. In Hong Kong, the government is making a sweeping overhaul of COVID policies. It's an attempt to revive the city's reputation as a global financial center. Hong Kong will scrap limits on public gatherings and no longer require proof of vaccination for entry to some venues. Customers of failed cryptocurrency exchange FTX have filed suit in Delaware bankruptcy court. They're hoping to be first in line to recover some of the billions lost in the meltdown of Sam Bankman-Fried's digital asset empire. The suit asks the judge to give customers repayment priority over other FTX creditors. Newly elected Republican Congressman George Santos poses a test for GOP leader Kevin McCarthy. Santos has admitted he fabricated stories of jobs at big banks, college degrees, and property ownership. McCarthy hopes to be elected House Speaker next week and needs every vote he can get. In the past, Santos might have been the subject of an ethics inquiry. McCarthy isn't saying what he'll do. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of the solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. This is all money in. This is me just building it.
It's pretty much full-service shadow banking with nobody in charge.
Welcome back to Bloomberg Surveillance. We are counting you down to the third last trading day of the year.
Is it?
We have 3 days left.
Today's Wednesday,
Today
right?
is Wednesday,
So
yes.
Thursday, Friday, yes.
Okay, and it does look, at least at this point, like it will be an update for the equity market today. Right now, S&P 500 futures up by about 0.25%. Seems like a little bit more conviction is coming in, but still at 38.64. We remain below where strategists at large thought we would be ending the year. They were guessing around 4,000, but we still have a couple days left. Meanwhile, in the bond market, the 10-year yield down about 2 basis points, 382 where we trade at the moment. So well off the highs of the year we reached really just a matter of weeks ago. And interesting to not see crude getting a bid here, Matt. WTI down about 0.3%, trading at $79.31 a barrel.
It was interesting, Ben Emmons was pointing out that the so-called Santa Claus rally that everyone was hoping for, that every year we talk about, actually happens the last 5 days of the year and the first 2 days of the following year, at least according to Yale Hirsch from the 1972 Stock Traders Almanac. So, maybe we still get that. Maybe we still make it to strategist year-end target of 4,000 and change. But it looks like it'll be by the skin of our teeth, as they say.
So Santa Claus comes to town after
after Christmas for Wall Street, right? Because you got to deliver the presents to the kids first. Now, the National Air and Space Museum is open to the public following a massive renovation. Bloomberg's Joe Matthews sat down with the museum's director, Christopher Brown, for a behind-the-scenes look at the Washington, D.C. institution, which includes new exhibits and an emphasis on how diverse voices played a role in air and space exploration. Brown told Bloomberg he hopes the museum will help spur more innovation.
It's known as a sanctuary, the iconic displays, the sense of history that it brings. So what's scarier, landing an F-14 on the deck of an aircraft carrier at night or re-envisioning one of the most busy museums in the world?
Well, I think the bigger task, quite frankly, is re-envisioning this national treasure for the future. I mean, we know its impact. You've just said it's influenced you. I came here in 1977, a year after its opening. I was 19 years old, and I was really struck by the DC-3 above us, because that was an aircraft I had flown in as a small child. And so I made that connection, and that led to my professional life in aviation. So we know the power of the place. Not as scary as landing at night on a ship, but very, very important.
The level of stress might be approaching that. It's interesting to think that this wing has been closed since before COVID, 2018. You said when it reopened recently, the real measure of success will be when visitors return home and say, "You must see this." Is that already happening?
Absolutely. We're getting about 5,000 visitors a day, and we've had really good feedback, both through the media and through our visitors. And I think part of it is because it's almost 50% of the artifacts in the museum today are here for the first time. And we're able to expand the storytelling in a way that the other measure of success is we hope that everybody coming into this museum, however they present, whatever they look like, wherever they come from, they will be able to see themselves in the stories and the artifacts, just as I did in 1977.
It's not lost on me that one of the big talkers here is this X-Wing fighter from the Star Wars movies. Obviously, it is not an operational aircraft or a piece of history the way some of these other exhibits are. But it speaks to the vision that you have in connecting fantasy with innovation. What's that lesson for young people?
Well, it starts with an idea, and there's that moment of inspiration, and it can come any number of ways. So, for instance, if you go into our Destination Moon Gallery, where we tell the story of Apollo, you'll see games and some of the things that the young astronauts were influenced by as children. So we know the iconic value or the influential value of these artifacts. And I've taken some heat for the X-Wings. People said it's never flown. Why is it in the Air and Space Museum? And I remind folks, I said, well, we have 6,000 paintings that never flew. So it's really a question of meeting our audiences where they are. What is it that connects to them, that resonates? And we know that the power of the X-Wing fighter does that for a lot of our audience.
Well, you've got a lot of competition for eyeballs and interest, right? You're trying to appeal to kids who are on TikTok and social media and have the attention span of a 10-second video. So I'm guessing this actually helps to bridge that divide.
It does, and I think that what we really hold dear at the Smithsonian and certainly here at this museum is a commitment to authenticity and accuracy, so that when you come here, whether it's in person or virtually, this is the real deal. And so sometimes some of the other media and influencers in our lives can't lay that claim. And so it's really important that we hold to that, because it's not just the artifacts and how real they are and authentic. It's the stories, the people's stories behind them.
There are amazing stories all around us, including that of the Apollo mission. The Apollo 11 capsule is something that reminds us of the harsh environment that is space. As you and I sit here, an Orion space capsule is orbiting the moon. How much do current events drive your vision for the museum?
Well, very much so. I mean, folks often think of museums having a retrospective look, and so it begs the question: why do we have a gallery dedicated to the Apollo missions? What's its relevance? The why? And other than the fact that it was just an amazing story, You know, the president just a few months ago, I think, used the term moonshot. So what does moonshot mean to a generation today that was not alive during Apollo? Most of the people coming into that gallery today will not have been alive to see the launches of the Saturn V's in the Apollo era. And I think the relevance and the reason we tell that Apollo story really gets down to 4 elements. One is, you know, to take on a big challenge and to solve problems, you need a strong vision. Certainly Kennedy articulated that. You need a commitment of national resource, 400,000 Americans, millions of dollars working on that project. You need a tolerance for risk. You have to be willing to take chances. And then you have to have that human ingenuity that I think is often underestimated. And when you put those things together, what the Apollo missions demonstrated is you can do incredible things. So fast forward, how does that play out with climate change and curing cancer and some of these seemingly intractable problems? I walk through that gallery and say, no, we can solve problems.
A 7-year project, I believe, in total?
Yes.
This is a huge undertaking. Does it have a price tag?
It does. This is an investment both by the citizens of this country. Their taxes have paid for $729 million of rebuilding this building. As you noted earlier, it's had a lot of wear and tear since it first opened over 40 years ago. But importantly, the actual galleries, the look and feel like this gallery is financed privately and through our corporate and individual benefactors, people that have trust in us and have given us their treasure, their donations to finish this project, and that equates to over $250 million.
$250 million. So you're a full-time fundraiser as well.
Indeed, but I remind myself, people don't give to me, they give to this museum and the stories that we're telling.
I'm compelled by your story, your personal story, your career. 315 traps, more than 1,500 hours flying the F-14 Tomcat, this iconic fighter plane that is just sort of has its own cult following now. You went on to be the manager of Dulles Airport, Reagan National Airport, the director here at the Air and Space Museum. But you've said in conversations that in flight school, you experienced something called, I believe it's a flight down?
Oh, yeah, absolutely.
That you actually failed the equivalent of a certain exercise that you needed to pass in your training. I just wonder how much that influenced your approach to your career or your trajectory after that.
Well, it's very humbling to be told that you failed in something you've worked hard at. But I think what it does is it's a real test of character to decide, you know, how invested are you in what it is you're doing? And just with exploration, with Apollo, with all these stories, there was failure along the way. And you learn from your failures. Now, it's always important not to repeat the failures, but to learn from them. But to think that we're going to do incredible things, either at a level like this museum, land a person on the moon, or in my case, learn to fly an aircraft on and off a carrier, failure is part of that process.
I love that conversation. I love anytime someone brings up F-14s because, you know, Matt, my dad was a naval aviator, and that was his plane. So go
That is
Tomcat.
awesome. I'm jealous. And, well, let me just say, Mr. Lyons, we thank you for your service.
Oh, thank you, Matt. I'm sure he appreciates that. I'm sure he's watching and listening right now.
Excellent.
Well, he's at home for the holidays. We, though, are not at home. We are working this week, continuing to work through the market action this morning. Just about 2 hours to go, 2.5 hours to go until the opening bell. Futures are up right now by about 0.25%. We'll discuss with Catherine Rooney-Vera of Baltic coming up. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
What about cryptocurrencies? Are you a believer in cryptocurrencies?
No, I'm not a believer in cryptocurrencies. And I would say that cryptocurrencies are a bubble. And I would describe cryptocurrencies as a limited supply of nothing. So to the extent there's more demand than the limited supply, the price would go up. But to the extent the demand falls, then the price would go down. There's no intrinsic value to any of the cryptocurrencies, except that there's a limited amount.
Well, based on what you've just said, why would you not put a big short of some type on cryptocurrencies? Or maybe you have, but do you think that's a good short?
Well, you know, when we look for these subprime, the reason why we shorted the subprime in size because it was asymmetrical. You're shorting a bond at par that has a limited duration that trades at a 1% spread of treasury, so you can't lose more than the spread in the duration. Yet if it defaults, you can make the par amount. In crypto, there's unlimited downside. So even though I could be right over the long term, in the short term, as the case of Bitcoin, you know, went from 5,000 to 45,000, you know, I would be wiped out on the short side. So it's just too volatile to short.
They've raised their inflation forecast.
Firm and immediate action.
He wants to destroy my country.
Elon Musk to buy Twitter.
Overturned Roe versus Wade.
Boris Johnson will call it
Donald Trump's plan to overturn the
unprecedented search warrant at the home of our former president.
Queen Elizabeth has died.
Xi Jinping got his third consecutive term.
The pound falls to an all-time low.
The shortest ever serving prime minister.
Presidents Biden and Xi shake hands.
FTX filed for bankruptcy.
The red wave that never was.
Protesting his zero COVID policy.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
We've flipped to good news is good news and bad news is bad news.
The worst won't happen by the end of the year. It'll happen somewhere in the middle of the year.
Expectations need to come down, right? So we've had an incredible run.
There's a lot of opportunity for positive surprises.
We're getting back into a more normal zone of consumer price sensitivity, and that's really key.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Just a few days left to go in a brutal year for equity markets around the world. From New York, for our audience worldwide, good morning. This is Bloomberg Surveillance on both television and radio alongside Matt Miller. I'm Kaylee Lyons. John, Tom, and Lisa are off today, and Matt is speaking German. Good morning.
To your dad.
Yeah, true. He also speaks it. We've talked a lot about my dad today.
Well,
maybe we should talk about these markets.
Yes. Well, you know what? It's been interesting because we have had a year in which at the beginning of the start of 2022, strategists were forecasting 4,900 on the S&P 500, and now we're not even at 3,900. So we're coming in 1,000 points below what we thought we would at the beginning of the year. Of course, we've had a lot of unexpected surprises, negative surprises, the war in Ukraine being chief among those. And that's what's been, really problematic for the energy sector, driven inflation higher, and probably will push us into a recession in 2023. And then the question is, do we even get to 3,900 on the S&P at the end of next year?
Yeah, and at least that's where consensus is now. But considering how much consensus had to change over the course of the last 12 months, it raises the question of how much up or downside there realistically is to those forecasts looking forward into the year ahead, because the consensus really seems to have built that it is going to be a very rough first half, that eventually at some point we will reach a bottom, maybe as low as 3,000 if you believe Mike Wilson over at Morgan Stanley, and then something in the shape of a recovery will take place, but only ultimately will get us back up to where we are now. So essentially a year of little to no return whatsoever. But again, upside or downside risk, given the year we have just been through, you cannot rule anything out.
Yeah, I mean, the problem is it looks like we're going to have a recession. If that's the case, then earnings are going to have to be revised down again. We were talking to Matt Maley at Miller Tabak yesterday, who said we haven't had any recession post-World War II where valuations haven't fallen to 15 times forward earnings, and we're still trading at 17.3 times forward earnings. So we still have a ways to go. 3,500 would be a best-case scenario in Maley's opinion if we get a recession, and probably below that.
Yeah, it's the idea that you have the top-down strategists saying earnings estimates need to go down, but the analysts are just simply not revising them any lower. So there's something of a mismatch there, which frankly we see pretty consistently. And of course, earnings are going to be more pressured if inflation proves more persistent. It all comes down to that inflation story, and there has been concern over the last 24 hours or so showing up, at least in the bond market, about China refueling some of that inflation as it opens up.
Yeah, absolutely. The reopening in China, one of the big stories at the end of 2022. So how do you prepare for 2023? How do you wrap up this year? Let's bring in Catherine Rooney-Vera to talk about that. She is the head of global macro research at Baltic, so she's one of those top-down people. Catherine, thanks so much for joining us. Coming into the studio in cold, dark, and wet New York. Are you from Miami?
I'm from New Jersey, but I live in...
You live in Miami, which is
I'd probably rather be in Miami.
I'd rather be there as well.
It's cold there too, but nothing compared.
So what do you think about this conundrum? We're at a point where it doesn't seem like a recession really is even priced in yet, and that's pretty crazy given that everyone expects a recession.
Yeah, I think we're already beyond talking about recession, and everyone's talking about recovery before recession has actually happened. And something Kaylee mentioned, it's all about inflation. Yes, it's about inflation, but for me, it's all about the labor market, because the labor market remains so strong, and 5-6% increases in salaries are not commensurate with a 2% inflation target. So my view, and you and I have talked about this previously, Kaylee, is that the Fed knows, in my view, that it has to get unemployment higher, and that it's horrible to say, but
by the way, we're going to talk with Claudia Sahm a little bit later. She of the Sahm rule.
The Sahm rule is,
and she thinks that's a mistake to argue that the Phillips curve is still alive and well, and you've got to push up unemployment in order to pull down inflation.
Well, I'd like to hear her view on where the NARU is right now. I think it's around 4.9%. We're at 3.7. So for the natural level of unemployment, if it is in fact 4.9%, anything below that is in fact inflationary. So what's her view on wage price spiral? If we look at...
Hang on, I'm writing these questions down. Taking notes.
If you look at history, an unemployment move of that amount has never not coincided with an economy already in recession. So I think that's important to note. The yield curve is pricing in recession. We know that, but there could be a normalization next year. And my thing is, everyone's talking about how 2023 the Fed isn't going to cut. But if you look also at history, the past 14 monetary cycles, the last hike versus the first cut, that timing is much shorter than you think. It's on average 4 months.
Okay, so maybe historically that is true, but if you listen to the Federal Reserve and Chairman Powell now, they are saying we are not going to do that. We are talking higher for longer. We are not giving up until inflation is back to our target, which right now is 2%. So even if inflation is cooling, we are still far, far away from that. What gives you the conviction that the Fed is actually not going to tolerate the weakness in the labor market and in the broader economy as they say they will and have to make that pivot?
Well, I think it's going to have to come down to how far the labor market rolls over. So I think unemployment goes to 4.9%. That's the NARU. It's hard to estimate, but
where are we now? 3.7%.
We're 3.7 in unemployment. So I do think the Fed needs to force the labor market to roll over because there's supply side forces and there's demand side. We all talk about both of them. The supply side forces are improving. Used car lots are packed now.
Yes, I've seen prices come down considerably in the used market.
And what you'll respond to.
Massively. I know you love cars. So I do think supply side forces are improving. You have China reopening, which you guys have been talking all morning about, especially you've been up so early. But demand side really hasn't taken that hit yet. And
by the way, we also got a $1.7 trillion omnibus. So that's another.
Was in my notes to talk about as well.
Yeah.
So we do have inflationary impulses, but that's going to aggravate the demand side, which hasn't yet rolled over. Consumption is still pretty good. It's been very resilient. If you look at Conference Board, that's been very resilient, and that has a very strong correlation with the unemployment rate. So if unemployment moves higher, Conference Board consumer confidence drops, you get a rollover in consumption. People are still spending, even though inflation is very high. It's because they have jobs.
Well, and when people are still spending, and maybe they're doing it by leveraging up, more so now all that pandemic stimulus money and savings built up has evaporated essentially. But what does that mean for corporate earnings? Because in theory, if people are still out there spending, tolerating higher prices, you're going to be able to continue passing on your higher input costs. And in theory, that would mean margins hold up and profits hold up.
Right. So you have nominal growth and inflation. So I do think that next inflation is going to come down. I do believe in a recession. I've been out of consensus on that since virtually the beginning of this year. I'm calling for recession as the next phase of the economic cycle. Stagflation to recession was my outlook piece for 2022. And I do think that we could get earnings having to be revised lower, and nominal growth, in my view, yeah, it's positive, but real growth next year I have at minus 0.4%. So that's year over year. So I have 3 quarters baked in of negative sequential annualized growth in the U.S.
I just want to make one point to the consumer because savings rates have fallen substantially. I mean, we, during the pandemic shot up to, record highs for American savings rates. And now we're, over 12%. And now we're back down to about 2% on savings rates. But I was talking with Mike McKee about this, and he pulled up bank balances. I've got the index in there. If the controller wants to bring that, bank balances are still holding pretty high right now. They've started to roll over a little bit, but they're still pretty fat. So the U.S. consumer shouldn't be counted out quite yet. There you see
And you can find this on your Bloomberg terminal for those listening on radio.
Yes, absolutely. Sorry, if you're listening on radio, let's just say they build up big time during the pandemic, and we show this, and they have held there pretty well. However, Kaylee points out, credit card debt is starting to climb again. The consumer's starting to leverage up. How do you take this all into account and put it into your investment strategy? What are you doing right now? Are you still defensive? And when do we find an inflection point when you really can turn around and start investing again?
That's a good thought. I'm still defensive going into next year. I still like energy, utilities, staples. I think you still have to remain defensive. But once you do get that change in the labor market, I think that's where the market drops a bit further. I think we could go lower in the S&P, and then I think we start talking about the Fed's guidance turning a little more dovish. So I am in the camp where the labor market determines how quickly the Fed could stop talking about higher for longer. And yes, the Fed's all in now, but the policy mistake has already been made.
Right. All right, Catherine Renuvera of Baltic, thank you so much for joining us in studio. How are you getting back to Miami? What airline are you flying?
Oh gosh, thank God not Southwest, but I'm not far better, Spirit. So
oh man,
for tall people like you and I, that's very complicated.
Yeah, it's difficult, and I don't envy you that. Actually, I have to say we're going to talk to Helene Becker a little bit later in the program.
We're deep teasing a lot
about the airline situation. Your comment on Southwest reminded me of that because she says they have a really strong balance sheet. So as an investment, maybe not the worst airline out there, but I have heard them referred to as Southworst because of the cancellations and delays that we've seen this holiday season.
Well, thank you again for joining us, Catherine. Best of luck
thank you very much.
In your travels. On the subject of Southwest, Matt, I just took a look at the stock and pre-market trading, down another 1% after a 6% loss yesterday because this thing is still not resolved. They say it could still be a reduced schedule for days, and if you believe the analysts over at Citi, it could actually translate into a non-insignificant earnings hit of
3 to 5%.
3 to 5%.
Yeah, I saw that as well. Still, better than Tesla, right?
I think most everything is probably better than Tesla.
You know what's interesting, actually, talking to Catherine, I wonder if we continue to see this dynamic of the market fighting the Fed next year, or the market sort of questioning the Fed's credibility. Until we see unemployment tick up, if we really do see the Fed, willing to raise rates into that to push us there, I think the market is going to continue to ask those questions of Jerome Powell.
Yeah, so it's a question of how aggressively the market pushes back against the Fed, and then also how hard the Fed pushes back in return, because they do not want to see an easing in financial conditions. This is a conversation we will continue to have. Coming up at 8 a.m., Christina Hooper, Chief Global Market Strategist at Invesco, will discuss with us more about these markets as we have futures in positive territory by about 0.2%. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. In western New York, the number of fatalities has risen from that record-breaking snowstorm. At least 31 people have died. The storm dumped more than 4 feet of snow on Buffalo. Meanwhile, travel is still a nightmare for thousands booked on Southwest Airlines. The carrier has already scrapped 60% of today's flights. Some stranded travelers face days of waiting. China's decision to abandon its COVID-0 policy and reopen its borders has prompted a global response. Countries are considering whether to test or restrict travelers from China. Beijing's policy reversal has triggered nationwide COVID outbreaks. Both the US and Japan are weighing new restrictions on people arriving from China. The Vatican says that retired Pope Benedict's health is getting worse due to his age, and that Pope Francis has gone to visit him. Benedict is 95 and served as head of the Roman Catholic Church for almost 8 years. In 2013, he became the first pope in 600 years to step down. The Biden administration will comply with the Supreme Court order that keeps in place sweeping coronavirus border controls. The court ordered that the restrictions known as Title 42 stay in effect whilst a lawsuit goes forward. President Biden says he'll enforce the order, but believes that lifting the measure was overdue. Bloomberg's learned that years of Donald Trump's tax returns will be released Friday by a House committee. Key identifying information, such as account numbers, will be blacked out. The documents will be the first complete look at the former president's tax records for the years he was running and in the White House. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
They've raised their inflation forecast.
Firm and immediate action.
Wants to destroy my country.
Elon Musk to buy Twitter.
Overturned Roe versus Wade.
Boris Johnson will call it
Donald
quits.
Trump's plan to overturn the
Unprecedented search warrant at the home of our former
Queen
president.
Elizabeth has died.
Xi Jinping got his third consecutive term.
Pound falls to an all-time low.
The shortest ever serving prime minister.
Presidents Biden and Xi shake hands.
FTX filed for bankruptcy.
The red wave that never was.
Protesting his zero COVID policy.
We should expect some crypto legislation. Now here, I don't think you're going to get the massive comprehensive bill that some want. Instead, I think it's going to be more narrowly targeted to stablecoins because that's something that Congress understands, kind of like a money market fund, kind of like a deposit account. They can get their arms around that.
Isaac Boltansky, BTIG Policy Research Director, speaking with us about crypto regulation yesterday after, Matt, what has, without argument, been a terrible, terrible year for the cryptocurrency world. We have seen implosion after implosion of major projects and exchanges, and yet Bitcoin on the year down 64%, which is nothing to sneeze at, to be sure. But you know what is down even harder on the year? Tesla down 69%.
Yeah, I think it's not as bad as Tesla is going to be my refrain for the end of 2022 because it's just been unbelievable to watch this crash. Of course, Bitcoin is down considerably on the year, but to me, it's still amazing to see Bitcoin trading at more than $16,000. I mean, I bought my first Bitcoin for $600, and I remember when Joe Weisenthal dared me to buy back in at 250. So 16,000 is still pretty amazing for lines of code, right? I mean, considering what it is and considering what has happened with the collapse of FTX, Bitcoin, initially dropped on that implosion, but since then has been so stable. Yeah. It's the envy of the rest of the market in terms of a lack of volatility.
Yeah, it used to be the poster child for volatility, and yet what we have seen time and again over various points of the year is Bitcoin getting stuck in really consistent ranges. That volatility essentially evaporating. Meanwhile, for a stock like Tesla, which was at one point this year a $1 trillion company, one that should not, in theory, be that volatile given its size, it's been the exact opposite, and it has been going bananas.
Yeah, to be fair,
11% drop yesterday.
11% drop yesterday really caught my eye when I came in this morning, and I think Ed Ludlow was telling us it's down like 25% over the past 7 trading days or something.
We should ask him.
We will ask him. I always pull up a comp screen when I'm looking at stocks when I really want to see how they've done against the broader market, against other competitors, and it automatically reverts to a 5-year window, which I think is a good window to look at stocks. You can cherry pick time periods, but still over the last 5 years, Tesla is up 420%. So if you're a long-term investor, it's not the worst thing that's ever happened to you. In fact, I'm sure you're quite happy about it. But at one point, it was up almost 2,000%. So it has definitely come in from the highs that we saw during the pandemic. Let's get over to Ed Ludlow right now, who covers Tesla for us, the whole EV space, all of tech, really, typically out of San Francisco. I believe you're still in London. Did Chelsea win last night?
Yep, 2-0.
Nice.
Horrible night, but 2-0, yeah.
Horrible?
You seem thrilled about that,
They
Ed.
scored 2 goals. That's amazing for a soccer game. It must have been exciting.
It was exciting, but it was cold. I was late, but I was happy to be back at the bridge for the first time in 5 years. Should we talk about Tesla?
Probably.
Yeah, what the heck is going on? I mean, yesterday you were telling us 7-day losing streak, the worst since I think you said 2018. It's dropped 25% over that period, 69% we now know year to date. Now, if we drop today, it could be the worst losing streak since the IPO.
I think we just have to go to the data. I would say that when I left for the stadium last night, the declines were significant, 11% decline in yesterday's session. But when I went to bed, I think RSI was at 16, right? So this pressure's been immense. So far over the last 7 days, 7 sessions, we're down almost 33%. Our year-to-date decline through Tuesday's close is 69%. So there's 2 ways of looking at it. We're higher by 1.6% in pre-market. You either say, well, Tesla has snapped its worst run of decline 7 straight sessions since September of 2018, or you go the other way and say this stock has avoided its worst ever run of declines. It's never dropped for 8 consecutive sessions. But what's really interesting
is it's way oversold. We should point out. I mean, you mentioned the RSI.
Way oversold.
You got to tell people that means the relative strength index, and if it's 16, it's deep into oversold territory.
I mean, deep. But the question now is why? You know, what's going on? You know, we started this conversation 2 or 3 weeks ago about key man risks. Elon Musk being too distracted at Twitter, not spending enough time at Tesla. A lot of investors took to Twitter and other forums to voice that concern to him. But really, actually, the narrative of the last few sessions, where so much of the pain's been felt, has been around demand. And, you know, the latest I guess, catalyst for that 11% drop in yesterday's session was a report from Reuters that between January 3rd and January 19th, Tesla is going to cut production in Shanghai, reduce production, and then at the end of January, following January 19th, they'll shut the plant down completely for the rest of that month to make scheduled updates or repairs, right, as part of the Chinese New Year. So there seems to be a worry here about demand, is what I'm saying, guys.
Well, if it is about demand, I wonder if we're talking about demand for electric vehicles broadly, or if this is about demand for Teslas and a market share question, Ed.
Yeah, I mean, there are many more options for the investor and the consumer now, right? There was a time where if you wanted to be an equity investor in electric vehicles, Tesla was the only game in town. That's not true. Rivian and Lucid are two pure play examples, but you look at them, I believe I'm right in saying they are the two worst performing stocks, Rivian and Lucid, on the NASDAQ 100 year to date. Their year to date declines at 80%, which is even worse than Tesla. So that argument doesn't really stand up. Then on the consumer side, there are just many more options available, right? Many more models. The legacy players from the United States and Europe are now starting to produce in more meaningful volume. But there is still noise from the market about this brand equity issue, right? The discount on Tesla right now reflects anxiety about Elon Musk and Elon Musk's behavior. That is one school of thought that's out there.
You are right, by the way. I just double checked, and you as well. We're holding you to your word, and you're right. Lucid is down 84% year to date. Rivian, which is such a bummer because I love the truck, is down 83% year to date. So both of them underperforming Tesla. What's the problem, by the way, with Rivian, Ed? You've covered this company in depth. Are they just not meeting production targets?
No, it's just that at the time of the IPO in November 2021, they just were so overvalued, frankly, right, that they shot past $100 billion of market cap. They then met the reality of production and production ramp coupled with the supply chain crunch. Remember, we started this year with Rivian hoping to make 50,000 EVs across the two consumer products and the van for Amazon. They look on track to do 25,000 this year, half that. And so investors have just pulled back their expectations that were so elevated, 6th biggest IPO in US history, because of the Amazon backing, because of, you know, this, it was sexy,
Ford
right? This was an electric pickup truck.
Yeah.
Right, and now reality takes hold.
And they come crashing back down to earth. Ed Ludlow in London, thank you so much, as always. All right, so we covered the EV part of the conversation, but we talked about the comparison in brutal punishment between some of these companies and crypto. To start off this segment, Matt, and on the subject of crypto, we continue to get updates around the FTX bankruptcy, the latest being that Sam Bankman-Fried says he and Gary Wang borrowed about $500 million from Alameda Research to buy that 8% stake in Robinhood. And my question now is, who does that stake belong to? And what happens with these assets over the course of the bankruptcy?
Yeah, and of course, normally the answer is it belongs to the executor who's running down the company and trying to pay back the people who lost money in the bankruptcy. The problem here is that there are a number of different jurisdictions that want to claim ownership over that. It's not just, you know, the bankruptcy court in New York or a bankruptcy court in Delaware, but it's, I think, Antigua wants a piece of it. The Bahamas wants that stake. Some failed crypto lenders who claim that they were given that as collateral, they want it as well. So it's very interesting. It's just one of the assets that creditors are going to pick over.
Yeah, and it's not just creditors. Customers also now actually suing because they want to be made whole first. So a saga we will continue to watch, but we are watching markets more broadly beyond just the crypto world. Right now, equity futures on the S&P 500 positive by around 0.3% at 38.65. The 10-year yield trading right now at 381. We will continue our conversation on these markets. David Sowerby, Managing Director and Portfolio Manager at Ancora, is joining us coming up. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg Surveillance on TV and radio alongside Matt Miller. I'm Kaylee Lyons. We are in this week for John, Tom, and Lisa, who are all on a well-deserved holiday break. And frankly, many people out there are. So trading volumes likely to be a little light today. But we are trying to see if Santa Claus shows up for this equity market. He already got all the gifts to the kids. Will he bring a gift to people who are long this equity market? Right now, at least, we are seeing futures in positive territory. A little bit more conviction as we draw closer to the opening bell in about 2 hours' time. Right now, S&P 500 futures up by about 0.3% to 3,865, if I can get my words out, Matt. But as you and I have been discussing over the last couple of days, that's still below where analysts or strategists were hoping we would end the year.
Yeah, we're looking for, I think, about 4,000 and change, depending on whether you look at the average or the median analyst estimate for this year. The same is true for the end of 2023. So strategists are basically saying we're not going to make any headway in 2023. They think, for the most part, that we're going to come down into the middle of the year and then come back up to where we are basically now by the end of the year.
So it's not about just us moving in a straight line and going nowhere over the next 12 months. A lot of volatility and a roller coaster is what is expected, even if it just brings us to the same place, because the consensus narrative right now, Matt, is that earnings expectations are going to have to come down. You are going to start seeing the pain in corporate profits of the tightening that the Fed is doing and the resulting demand effect it has in the U.S. economy. And as a result, more pain is likely to come for the equity market, at least in the first part of the year. It then becomes a question of if the Fed is going to pivot and if a recovery will quickly follow that bottom.
Well, and to your point earlier, it's interesting to see that top-down strategists are really negative on earnings, but bottoms-up analysts are saying we should see more, like $220, $230 at the end of the year, whereas top-down strategists are saying more like $200 or $210. So there's a huge delta there. I think Tom would say that, delta.
Any Greek letter works for Tom.
It's difficult to do this. I never know which camera. Tom, John, and Lisa have at least 6 different cameras plus a handheld, and there we are. And so
for our listeners on radio, you are spared right now our bobbleheads.
Yes.
That we are
but
experiencing.
You're missing out on my beard.
This is true. I think we should, I'm going to put a poll out on Twitter on whether or not we like the bearded look on Matt Miller. So everybody feel free to share your thoughts.
Let's get back to the important business of the day, and that is the markets. We are fortunate enough to have David Sowerby standing by, Managing Director and Portfolio Manager at Ankara. David, thanks so much for joining us. There's a couple of dynamics that Kaylee and I have been talking about a lot today. It's the kind of fight between the market and the Fed. The market doesn't quite believe that Jerome Powell is willing to keep pushing even into higher unemployment, even into really difficult, equities prices, and especially not if it breaks the fixed income side of things. The other dynamic is that top-down strategists see it very differently from bottoms-up analysts when it comes to earnings. Help me, please, in terms of what I should be looking at for 2023.
It's Matt. Love the beard first.
It's 80% of it is going to be the micro. It's the bottom up. What are companies specifically telling you? That matters more than all the Wall Street strategists lined up end to end. Probably still can't reach the right conclusion. But the bottom up is companies are still generating 11 to 13% free cash flow margin, and are selling at attractive valuations on a free cash flow basis, as well as price to earnings. That's what's going to guide me in 2023. And the negative sentiment is actually good for next year's returns as well. So I more often than not want to be fully invested in stocks.
Is that equation going to continue to make mathematical sense if the Fed raises to 5.5%, if unemployment goes to 5%? Are we still going to see those earnings pan out in 2023?
Well, they could certainly go lower when we start to get the news for Q4 earnings. They could go lower, but at a free cash flow yield, free cash flow divided by market capitalization, I'm finding companies at a 6 to 7% free cash flow yield. That compares very favorably to the 3.7% yield on a 10-year treasury. I think the market has some room to digest a little bit more negative activity, that the Fed still has more work to do to get inflation at least into the 3% handle. But here we are, fourth quarter, we're up about 10% for most investors. I think that sets the table for 2023 being a little bit better than average. That might not be consensus, but I think it holds.
Well, you say up 10%, which is what the annualized total return for the S&P 500 has been over the course of several decades now. But if we're talking about a world, and if even the Fed pauses, even if it pivots and begins to cut, the consensus I seem to be hearing is that we aren't going back down to the zero bound, that we just do not live in that world anymore. So how do expectations for what kind of returns you can generate in equities need to change to reflect that?
I think if you set the table for the S&P 500, which may not be the best barometer next year, up maybe 5 or 6%. But then if you still lean value, if you still dig down into more of the mid cap and a small cap range, then I think you can see a high single digit rate of return. That's going to outperform bonds. It's going to outperform most other asset classes. And frankly, the Fed still needs to do more work. There aren't enough monetarists at the Federal Reserve Board that recognize that inflation is and always will be a monetary event. They have to keep being a little bit more restrictive, probably for the first quarter. And then once the incremental inflation news gets better, and it is starting to, then I think it sets the right backdrop for the, let's say, a tempered risk-on strategy.
So in your mind, when we think about the risk of the Fed overdoing it versus the risk of the Fed underdoing it, which one is greater?
Well, they tend to always overdo it, whether it's on the stimulative side or the restrictive side. There's a good chance that they could overdo it. But I think, number one, if you just look at the return on stocks from about 1967 to 1982, inflation adjusted, they were down 50%. So if the Fed overdoes it a little bit to get inflation back into that 3% handle, I may not like it in the near term, but I sure like it when I look out 3 to 4 years and say, where am I going to meet my pension fund liabilities? Where am I going to get returns? Then it's a stock market that's back in that 7 to 8 to 9% rate of return, which will beat other asset classes.
Well, and you were on the investment advisory committee for the Michigan pension fund. It's a $50-60 billion pension fund there. How are those big institutions going to fare into 2023? You advised, obviously, big institutional clients when you were at Loomis Sales as well. Are they going to be able to get the safe returns that they need?
I think if they're just looking at 2023, it's not the right thing to do. 10 years is too long, frankly. So you try to put a lens at 2 to 3 years, Matt. And in that environment, it's still I want to have at least 50 to 60% of my assets in public equity, particularly leaning to the U.S., absolutely. And then it's in the alternative areas that is a substitute for some of your traditional fixed income, whether it's the state of Michigan, it's very skilled in private equity. I sit on the city of Detroit's investment committee out of bankruptcy. We're looking at private credit as a solution outside of traditional fixed income. That's how it all comes together like a good orchestra, and you can generate returns between 6 and 7% for the total fund. That's going to be the case over the next 2-3 years, and I think it's an achievable goal.
Yeah, I see that the governor appointed you to the Economic Development Corporation for Michigan as well, David. How is the economic situation in the Motor City? You're so deeply ensconced in Ann Arbor, Michigan, Detroit. How are things going there as we see companies like Tesla and Rivian producing EVs elsewhere? Nonetheless, seriously underperforming, at least on the equity side, General Motors and Ford this year.
The bottom line for Michigan and Detroit is it's in a much better economic shape than it was in the decade of the 2000, which was a lost decade. Tax Foundation ranks the state of Michigan number 12 in the country for competitiveness. That's the best research on how competitive your state is. In my mutual fund, anecdotally, there's 31 stocks. One of them is General Motors. We own many Michigan small cap companies like Jackson National and Lansing. So I think the prospects for Michigan are pretty good, even when we know in recessions the state of Michigan gets hit a little bit harder. The combination of job growth and income growth, that's prosperity. Michigan is faring quite well.
David, the Wolverines absolutely embarrassed the Ohio State Buckeyes. I mean, it was a horror show. Nonetheless, we could see a rematch if Michigan beats TCU and much bigger if the Buckeyes beat Georgia. What are your predictions for the all-important? I mean, this could be the biggest game ever for a national championship.
Back to when Michigan beat Washington State for the national championship in 1997. I remember that year vividly. My prediction, Matt, is about as good as my prediction for annual returns for the stock market. You might as well flip a coin. Nevertheless, Michigan gets by TCU. You hope Georgia beats Ohio State. I don't want to see another rematch. And then Michigan goes toe-to-toe with Georgia with a rematch of last year. And maybe at the end of the day, Michigan's great kicker kicks a field goal, and we're talking the first national championship for the state for Michigan since 1997.
Well, that is a comeback. That would be an amazing comeback.
How's that for a prediction?
We love it. David Sowerby of Ancora, thank you so much for joining us on all things markets and football. I have to say, Matt, I'm at the point with Georgia, like I was with Alabama for so long, where I just automatically root against them because it's no longer fun when you're that good.
Well, I'm certainly rooting against them when Ohio State plays them. I think the game is on Saturday night, and I'm going to be skipping any New Year's Eve celebrations to watch that. I do hope for a rematch. I want to see the Buckeyes come back and get a chance to prove themselves against the Wolverines, because if they don't, then I'll know how much Michigan has earned it, right? Of course, Georgia is a better football team, so it's unlikely that the Buckeyes are going to win, but what an amazing comeback it has been for the Wolverines. And for the rivalry, I think it's been pretty amazing. By the way, David Sowerby comparing it to compounded annual returns for the stock market, he pointed out over the last 70 years, we've had 10% compound annual returns. So although you don't typically see that in one calendar year, as long as you're fully invested, you participate in that.
Yeah, and if you're of a certain demographic, perhaps closer to my age, that's all you've ever known, but it could be a brave new world. All right, we're going to continue our conversation. Coming up, Helene Becker, Senior Research Analyst at Cowen, will be joining us to walk through the drama with the airline, specifically with Southwest, which is still struggling with delays after that Christmas storm. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Stranded travelers in the U.S. could face days of waiting to get to their destinations if they're booked on Southwest Airlines. The carrier has already scrapped 60% of its flights today and about 20% of tomorrow's. Meanwhile, in western New York, the death toll has risen to 31 from that record-breaking storm. The city of Buffalo is digging out for more than 4 feet of snow. In Hong Kong, the government is making a sweeping overhaul of COVID policies. It's an attempt to revive the city's reputation as a global financial center. Hong Kong will scrap limits on public gatherings and no longer require proof of vaccination for entry to some venues. Customers of failed cryptocurrency exchange FTX have filed suit in Delaware bankruptcy court. They're hoping to be first in line to recover some of the billions lost in the meltdown of Sam Bankman-Fried's digital asset empire. The suit asks the judge to give customers repayment priority over other FTX creditors. Newly elected Republican Congressman George Santos poses a test for GOP leader Kevin McCarthy. Santos has admitted he fabricated stories of jobs at big banks, college degrees, and property ownership. McCarthy hopes to be elected House Speaker next week and needs every vote he can get. In the past, Santos might have been the subject of an ethics inquiry. McCarthy isn't saying what he'll do. And air travel is roaring back. The problem is there just aren't enough planes. Jefferies estimates there's an order backlog approaching 13,000 airliners. Boeing and Airbus are sold out for their most popular single-aisle models through 2029. The result, airlines have fewer seats to sell, which means fares will stay elevated. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full-service shadow banking with nobody in charge.
Tools we use to recover from disruption serve us well 99% of the time, but clearly we need to double down on our already existing plans to upgrade systems for these extreme circumstances so that we never again face what's happening right now. We're focused on safely getting all of the pieces back into position to end this rolling struggle.
Bob Jordan, Southwest Airlines CEO, speaking as the airline continues to struggle with the aftermath of that chaotic winter holiday period over the weekend, in which we saw significant weather delays across the airlines and a lot of cancellations, but Southwest by far the worst. They're still struggling with it. The stock also still struggling this morning, down about 0.8% after a 6% decline yesterday. For the equity market more largely, though, it is positive in the futures session. Right now, the S&P 500 futures are up about 0.3% to 38.66, and the 10-year yield is moving lower, so maybe that helping assist risk sentiment here. The 10-year down by about 3 basis points to the 380 level, while crude is up by about 0.5% to $79 a barrel. And just taking a look at natural gas as well as we talk about that winter weather, Matt, interesting to see natural gas futures down by about 5.6%.
Yeah, let's talk about all of that with Madison Mills right now, Bloomberg Quick Take. She joins us in the studio this morning, and let's talk first, Madison, before we get to the power grids and the gas prices, about the weather chaos that we've seen canceling thousands and thousands of flights. What are the details?
It's
very chaotic, and it doesn't appear to be letting up anytime soon. Matt, we are seeing just in Buffalo 31 dead, 4 feet of snow as of this morning, and it is expected to warm up over the course of the weekend, heading into next week. But just as we're starting to see conditions in the Northeast get a little bit better, in the West we have this atmospheric river event that's already starting to cause chaos. We're seeing in the Bay Area roads closed, power lines down.
Atmospheric river event? What is that?
Atmospheric river event. Yeah, so that's the
Sounds
big
bad.
meteorologist terminology here, but basically just means there's going to be heavy rain, heavy wind, and even snow in some parts of the Northeast, particularly Portland, in northern parts of California, a lot of areas that aren't equipped to deal with the snow, and that might lead to a similar situation to what we saw in 2021 in Texas. The idea there being that it's a warm area, they're not used to dealing with this.
Well, and their power grid was ill-prepared for a weather event, not just necessarily snow, but the temperatures and people being able to power their homes and heat their homes and keep themselves warm and alive. To what extent were power grids prepared this time around, having states like Texas already gone through an experience like that last year?
Yeah, so there are these backup systems in place so that, you know, the half of U.S. households that are heated by natural gas can have a backup plan to stay warm. And those backup systems, as we've seen, failed over the course of this week as well. So really pointing to the need for a lot of infrastructure change. We saw Secretary Pete Buttigieg even mentioning this last night to NBC, that there just needs to be a lot of infrastructure change and investment in clean energy systems that are going to provide a good backup plan when these systems go through these issues. I do want to point out supplies of natural gas plunging their most in over a decade last week. So just severe drop-offs in supplies across the U.S.
Yeah, I remember Obama talking about the need for an update to our infrastructure, and that was a while back.
Yeah.
So it doesn't, I'm not confident that we're going to learn our lesson even from these issues. The airlines may be a different story. Madison, thanks very much. Madison Mills from Bloomberg Quick Take talking to us about the weather and the chaos that it has caused for travel and for consumers alike. Let's go though and focus in on the airlines. Helene Becker joins us right now, Senior Research Analyst at Cowen. Helene, thanks so much for coming on Bloomberg again. We just talked to you last week, but since then there have been thousands and thousands of cancellations. As Madeline says, we're not close to getting back on track here. How is it right now, especially for Southwest?
Good morning. Yes, we are not close. Southwest is not close. Everybody else is pretty much within what I would call their normal course of doing business. The cancellations are relatively low. Southwest accounted for more than 80% of all cancels yesterday. And for them, they're just behind the curve here, and they probably won't get caught up until the weekend at the earliest.
Well, and we have seen modeling from analysts over at Citi that talks about a 3 to 5% earnings hit for the fourth quarter. But I'm wondering what kind of signal this is on the longer term operational health of Southwest beyond just what is ongoing currently. If something like this could happen at this scale for this long, does that just mean they're ill-equipped to handle weather events like this? I mean, what went wrong here that could go wrong again?
Yeah, they had a confluence of a lot of events. So you had the weather, and it moved across country, hitting Denver and Chicago particularly hard. United is in both of those locations, didn't get hit quite as hard, but still impacted. For Southwest, though, I think at Midway, there was a lack of de-icing fluid. Then they had an issue in San Diego with fog. They had ice in Dallas. So everywhere they were, they had weather. And the worst of it is their systems are just not equipped to handle it. Historically, Southwest underinvested in IT, in technology, and this has come back in the past to hurt them. They were investing aggressively this year. That was one of the catalysts we thought, for the shares later this year as the new scheduling system for employees was coming up. But one of the issues we saw yesterday was an aircraft with a bunch of flight attendants deadheading to a city. But the crew working the plane was short a flight attendant. And according to the pilot on board, any one of those other flight attendants offered to work the flight, but they couldn't get through to scheduling to say, hey, we're here, we'll take it. And so Southwest canceled the flight. They're doing what should be automated by hand. When you have 6,000 flights a day, and you probably shouldn't, you should probably have 2/3 of that. It's not that they don't have enough people, it's that they don't know where their people are. So they have to reset the entire airline.
So it's a broken system, essentially.
Yeah, I mean,
I think so, yeah.
It doesn't make much sense because I understand that the weather is very bad in some places. My buddy Kareem just showed me a picture of his parents' house in Buffalo, and it's completely snowed under. On the other hand, Helene, I'm 49 years old. It snowed most winters of my life. This happens in the winter months, and an airline especially should be prepared for it. Has Southwest management learned any lessons? Will they invest? Will they, stock up at Midway with some de-icing fluid?
Yeah, so sometimes they get caught out, but you're absolutely correct. And I think people have a right to be really angry and annoyed because, to your point, this is 2022, almost 2023. They should have invested years ago in these systems, and they just didn't.
Well, do you change your opinion on the stock, Helene? Because you liked Southwest before this.
Yeah, no, I don't think we do. I think that the shares are reflecting the disaster that's befallen them. I think you'll see the impact. You mentioned the 3 to 5%. We think it will be in the hundreds of millions of dollars range. They're doing everything they can. For example, refunds, 100% of your cash back. They're offering to buy you tickets on other airlines if you can even find a seat. So consumers should totally keep their receipts to submit them to the airline. And then I suspect in the first quarter, we'll see them heavily discount tickets to encourage people to try them again, and then this investment, I suspect they'll do everything they can to speed it up. And you're right, there was a fuel shortage at one location, but we're seeing sporadic fuel shortages around the country, and airlines are tankering fuel where they need to. But I think the other part of what Southwest needs to do in the short term is cut back their ambition, because even though they've hired enough people, not everybody is fully trained, so the schoolhouse is full as they work through this and get back up to speed. But I just, Kelly and Matt, I just don't see how they get by with another storm like this without super investment in systems to improve things.
Yeah, well, clearly something's got to give, because there are a lot of people, including the Department of Transportation, who are not thrilled by this episode. Helene Becker of Cowen, thank you so much, as always, for providing us your insight. Absolutely. And you know what I'm hoping 2023 brings, Matt? Other than better weather, cheaper airline tickets.
I thought you were going to say flying cars.
Well, that would also be cool. That seems less realistic.
Yeah.
Fares going down because of demand going down, trying to get inflation down in general, seems like the more realistic scenario there.
I don't know how much cheaper airline tickets could really get. And I always think about, when I was a kid in the 90s, I flew out to the West Coast to see the Grateful Dead, and then I flew out to see them again in 2015. My ticket cost the same over a 20-year period, so they really haven't moved up that much.
And Fish, right, this weekend?
Fish on Friday. I got a ticket. Thank you very much.
All right, stick with us. We're going to be speaking with Christina Hooper, Chief Global Market Strategist at Invesco. Coming up next, futures positive by about 0.3%. This is Bloomberg.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. And even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at a 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and will continue to do so. We'll take a little bit of a margin compression on that, as we've had to, and I think that's the right thing, so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
They've raised their inflation forecast.
Firm and immediate action.
He wants to destroy my country.
Elon Musk to buy Twitter.
Overturned Roe versus Wade.
Boris Johnson will call it
Donald Trump's plan to overturn the
unprecedented search warrant at the home of our former president.
Queen Elizabeth has died.
Xi Jinping got his third consecutive term.
The pound falls to an all-time low.
The shortest ever serving prime minister.
President Biden and Xi shake hands.
FTX filed for bankruptcy.
The red wave that never was.
Protesting his zero COVID policy.
We've flipped to good news is good news and bad news is bad news.
The worst won't happen by the end of the year. It'll happen somewhere in the middle of the year.
Expectations need to come down, right? So we've had an incredible run.
There's a lot of opportunity for positive surprises.
We're getting back into a more normal zone of consumer price sensitivity, and that's really key.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Is the Santa Claus rally finally coming to town? Live from New York for our audience worldwide, good morning. This is Bloomberg Surveillance on both television and radio. Alongside Matt Miller, I am Kaylee Lyons. We are doing our best to fill the shoes of Tom, John, and Lisa this week.
Giant shoes.
Giant shoes, especially in the case of Tom Keene. But of course, they're absent on a holiday week, which means volume is light. But nonetheless, with that caveat aside, we are positive in the feature session.
What would you guess Tom wears? Like a 14?
Oh,
would you say?
I have no idea.
13 or 4? I would guess a 13 or a 14.
All I know is I'm not a short person, and he still towers over me. So that would indicate.
And me.
Yes,
you know, I think he
true.
must be like 6'7", because I'm 6'4", and he's definitely much taller.
That's why he gets the big chair, which you are currently sitting in.
Yes, I'm not sure I can fill it, but I can tell you that we are seeing futures higher right now. We are seeing European equities trade higher as well. We did see that at this time yesterday, and then we saw a real turnaround. Dragged down the market was by the big tech companies, Apple and Tesla. Concerns about Apple's cell phone production, concerns about Tesla's car production, especially in China, really dragging us down and giving us an eye-opening 11% drop in Tesla. 7 days in a row, the stock is down 69% year to date.
And we know that historically, the direction that those stocks move, that tends to be the way the broader market moves, just given they are such heavyweights. But to your point on Tesla, it is far less a heavyweight than it was earlier on this year. At one point, it was one of the largest companies in the S&P 500, worth over $1 trillion. It is now not even in the top 10 in terms of market value after seeing $700 billion wiped off its market value this year. Our producer, Pete Diatoris, who's great with the superlatives, actually sent me a note earlier this morning about how Tesla right now is on pace for its worst year and quarter of all time. It has seen bigger intraday drops than that 11% we saw yesterday, but over the longer term, we just have not seen moves like this for the stock since it went public.
It's doing worse than Bitcoin.
Which says so much,
Yes.
right? In a year like this one.
I think for Tesla, for big tech, for crypto, it has been an annus horribilis, as the queen
Latin.
would have put it. Well, you know what? I got that from Christina Hooper. She joins us now, Chief Global Market Strategist at Invesco. And Christina, I guess you got that from Her Majesty Queen Elizabeth. But she wasn't talking about stocks and bonds. What does 2023 look like if we've had, the pandemic leading into incredible inflation, then the war in Ukraine making it worse, the Fed hiking us into maybe a recession? How does 2023 look any better?
Well, I think that after several extraordinary years, and when by extraordinary I mean extraordinarily bad and traumatic, what we're getting to is a more normal environment where we're likely to see the Fed ease what has been a dramatic level of tightening. So I don't mean ease per se, but certainly downshift its tightening and ultimately hit a pause button in the first half, probably the first quarter of 2023. We're likely to see inflation continue to moderate significantly in 2023. So something of a return to normal. It's not going to be an easy transition, but I suspect that 2023 is going to be a lot more normal than the last 3 years.
But the normal of at least the last decade or so, Christina, has been leadership by big tech and stocks being able to fly high because money was free, and with low borrowing costs, it's okay to have a higher multiple. That is not really the world we have lived in 2022, and in theory, that's not going to change incredibly quickly. So just using a stock like Tesla as an example, how much more do you think those stocks need to deflate? How much more devaluation could be coming for certain pockets of the equity market?
Well, clearly tech is under pressure. The high valuation areas of the stock market are under significant pressure, and that doesn't change overnight. In fact, when we get to more of a risk-on environment, as global risk appetite grows, we're likely to see a movement towards lower valuation names, more cyclicals. I don't think this is going to be a time where we see tech rebound dramatically because rates are so much higher. Now we will go through an adjustment period. We've already started that process. We could see more of that in 2023. But again, it's going to be a more normal environment, which means we're unlikely to see outsized gains by tech. We're really unlikely to see big gains by stocks in general in 2023. But I do hold out hope, and I believe strongly that we're likely to see a positive single-digit return environment, for example, the S&P 500.
You know, Christina, yesterday we were talking with Matt Maley and Miller Tabak, and he pointed out we're looking at, I think, 17.3 times earnings, forward earnings on the S&P 500 now. Since World War II, in any recession, if we do get a recession, valuations have dropped to 15 before the bear market ended and turned around. Do you expect that we could fall that far, because that would put us, at 3,500 or maybe even below before we can turn around and climb back up into the end of the year?
Well, we have to keep in mind that this is a very compressed economic cycle. So things are moving a lot faster than they typically do. So I think we're going to see a number of different forces converge at the same time. So we will have that headwind of downward revisions to earnings. I mean, that's a given. We haven't seen that priced in yet. But having said that, we also have a market looking ahead to the potential for the Fed to cut rates by the end of the year. And certainly just hitting the pause button will take pressure off risk assets. So I think that we could actually see earnings downwardly revised. At the same time, we could potentially see, as the year progresses, some movement towards multiple expansion.
Okay, so that's all on the equity side, Christina, but we know that, or at least we have heard that there are now alternatives to equities. Those have
Reasonable
now emerged. Tara, right?
Yes,
Tara?
yes.
Tara?
I think Tara. I knew a Tara. I wasn't ever sure about, but I'll say Tara.
Okay,
yeah.
so however you want to pronounce the acronym TARA rather than TINA, TINA, there was no alternative for equities. It seems that that world has now changed. How are you viewing bonds into the new year and how much you want to be allocated in that asset class rather than into equities?
That's a great question. And of course, fixed income had an annus horribilis in 2022 as well. That's part and parcel of what we saw in terms of a dramatic tightening cycle on the part of the Fed and other central banks. So where we find ourselves today is looking out on a year in which we're unlikely to see much more in the way of rate hikes, certainly relative to what we saw in 2022. That gives some breathing room for fixed income. At the same time, we've seen yields go up significantly, making, as you pointed out, many areas of fixed income quite attractive. I would focus on investment-grade credit as we see this struggle between a risk-on and risk-off environment. The level of the maturity wall is pretty low right now. We don't see a lot of debt maturing in the next 18 or so months. So this is a good environment. Companies are fundamentally more sound in general than they were in the last significant recession we went through, the global financial crisis. So this is a very different environment. Now, as we transition through the year, as we get through a downturn in the economy and look forward to an economic recovery, that might be a time to increase a risk appetite and move towards high yield. But certainly right now, investment-grade credit looks very attractive.
All right, Christina, thanks so much for joining us. Really appreciate your time this morning, especially during a holiday week. Christina Hooper there talking to us from Invesco out of Connecticut. I wonder if she plays pickleball. I should have asked. I need to gather pickleball players.
You should start a league.
And paddle players around the Westchester, Connecticut area. So I'm putting out the call right now if anybody wants to play.
I've played pickleball, I think, exactly 3 times.
Well, how much fun was it?
It was fun. I'm not the world's greatest athlete. That isn't where I shine.
I don't believe that.
So I could use more practice.
Well, then you can practice with me because I'm picking it up as well. What a great Christmas sport it's been. It's turned out to be. Of course, I guess, you know what the cool thing is? Platform tennis, paddle tennis, I've been playing my whole life, and I recently got my wife into it. I found out when she got into it that it was actually invented in my backyard. Literally in my backyard. In Scarsdale. The first ever players were a couple of guys in Scarsdale. One lived in my house, the other in my neighbor's house, and they got together in 1925 and built the first platform tennis court behind our homes. And
that's really cool.
It's cool history,
If
right?
you ever decide you want to sell your house, you should definitely include that in
they
the
didn't
listing
tell
for
us.
its
They didn't
historical
tell us that
significance.
when we bought it. So
I feel like I need to update everyone on the status of our beard poll, because if you are listening on radio, you haven't seen it, but Matt Miller is attempting to grow a beard. It seems more people are fans.
You've got to give me a little time, though.
They would like to see it, fill
It's got to
out
fill in a little. It's only been 2 weeks. Can we get a close up? It's only been a couple of weeks, and the thing is, I'm not sure if my boss is going to like it or my wife.
Well, maybe if we get enough people voting yes on the poll, that'll override that opinion.
Yeah.
There we go. That's a nice zoom in. Right now on Twitter, 55% of people say keep it, 44% say shave it.
That's close. That's pretty close.
All right, poll's still open, so if you want to vote, go do that.
We are looking at futures right now, up about 0.25%. Yesterday, we saw the same thing around this time, but that then turned around dramatically at the end of the day. So we'll see if we come down again. At 8:45, Kaylee will talk to Gerard Cassidy, head of U.S. Bank Equity Strategy at RBC Capital Markets. On the other hand, will take, that's the John Farrow break, right?
Yes.
8:45
You got to go
9.
get ready for the open. It requires some preparation.
He stretches out,
refuel.
Puts on a different blue suit. I think he changes the blue suit every day between surveillance and the open and focuses in. He takes his focus away from macro and the Fed and fixed income and focuses in on equities for the stock market open at 9:30.
Yep, that's coming up quickly. And as you say, Matt, equity futures right now are in positive territory by about 0.3%. Interesting to see a reversal in the bond market after big moves upward yesterday. Yields coming in by about 3 basis points on the 10-year Treasury to 3.8%. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Stranded travelers in the U.S. could face days of waiting to get to their destinations if they're booked on Southwest Airlines. The carrier has already scrapped 60% of its flights today and about 58% of tomorrow's.
I want everyone who is dealing with the problems we've been facing, whether you haven't been able to get to where you need to go, or you're one of our heroic employees caught up in a massive effort to stabilize the airline, to know is that we're doing everything we can to return to a normal operation. And please also hear that I'm truly sorry.
Southwest shares are down in the pre-market trade after falling 6% on Tuesday. China's decision to abandon its COVID-0 policy and reopen its borders has prompted a global response. Countries are considering whether to test or restrict travelers from China. Beijing's policy reversal has triggered nationwide COVID outbreaks. Both the US and Japan are weighing new restrictions on people arriving from China. The Vatican says that retired Pope Benedict's health is getting worse due to his age and that Pope Francis has gone to visit him. Benedict is 95 and served as head of the Roman Catholic Church for almost 8 years. In 2013, he became the first pope in 600 years to step down. The Biden administration will comply with the Supreme Court order that keeps in place sweeping coronavirus border controls. The court ordered that the restrictions known as Title 42 stay in effect whilst a lawsuit goes forward. President Biden says he'll enforce the order but believes that lifting the measure was overdue. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
60-40 didn't work in 2022, but it is set up for a good run in 2023. Expectations need to come down, right? So we've had an incredible run, but it doesn't mean that you have, some big massive sell-off. You just have to temper expectations.
Justin Bergen, Ameriprise Director of Equity Research, speaking with us yesterday about the idea that earnings estimates need to move a whole lot lower, that maybe expectations are not actually matched with reality at this point. And of course, Matt, we aren't all that far away from the next earnings season. JP Morgan's going to kick us off on January 13th, which is what, a little over 2 weeks from now?
Yeah, and I'm looking forward to that, obviously. But what really matters is, I guess, how earnings fare throughout the next year, right? Because the concern is that we go into a recession, and that's driven by the Fed tightening financial conditions, which means it's going to be more expensive to borrow money to buy a house, more expensive to borrow money to buy a car. They're going to put unemployment at a higher level. Right now, it's at a pretty low 3.7%. So if all of that happens, can companies meet earnings expectations, which currently stand, according to our survey of strategists, at $210 at the end of 2023?
Right. It all comes down to essentially whether the demand destruction is actually going to take place in a more material way. That is exactly what the Fed is trying to engineer with higher borrowing costs, basically deter people from borrowing and from continuing to spend their money. But so long as they do, companies have the ability to pass on higher input costs and raise prices. And to this point, consumers have been tolerant of that. I guess it's just a question now of how long that lasts. Let's get a quick check on the markets as we are just about an hour and 15 minutes away from the opening bell here in New York. At the moment, S&P 500 futures are right around session highs, up about 0.3% at 3,867. But of course, as Matt has pointed out, we also were positive at this point yesterday, and we saw rolling over throughout the trading day. So we'll see if this rally can indeed stick. What is interesting is you are also seeing a rally in the bond market. Yields reversing some of yesterday's move, with the 10-year moving down by about 3 basis points to 3.8%. I mean, we can talk about volatility in the equity market, Matt, but in the bond market as well. From the highs we reached earlier at the end of the fall, back down to what, 350, and now we're back up to 380.
Yeah, we down to almost 340 actually about a month ago. So, and we were up at 425. So we've seen real volatility. I mean, just look at the MOVE index. It's ticked up very high, especially when you put it against the backdrop of the VIX, which really hasn't. So one of the questions is the VIX broken? I think the interesting thing in fixed income is that the market is really pushing Jerome Powell. They may not believe that the Fed is going to keep on this tightening path until, I think 466 was the median dot a couple of months ago. Now, what is it, 5.25 is the median dot for 2023. Let's bring in Barry Ritholtz, host of the Masters in Business Bloomberg podcast and the CIO at Ritholtz Wealth Management, as well as an opinion writer for Bloomberg Opinion. Barry, what do you think of this dynamic? The market just continually pushing against the Fed, not believing what Powell says, and the Fed has to keep coming out and proving the market wrong. How long can it go on?
Well, when you look at the long history of Federal Reserve forecasts, not only about the economy, generally the consensus tends to be not that great as a group of forecasters, but as to their own behavior, they're pretty awful at it. And in fact, when you go back a year from now, even after inflation had ticked through 2, 3, 4% CPI, go back a year ago, the Fed was still talking like, hey, we're going to be lower for longer, and there isn't a whole lot of expectations we're going to change. So the street is appropriately skeptical that the Fed is going to do what it says. Also keep in mind that I think the street, Wall Street and finance, is much savvier as to the realities of inflation than the Fed, which tends to be more academic, whereas the street is much more pragmatic. So the street knows goods inflation has already come way down, and they also know services have rolled over, but it just hasn't showed up in the models that the Fed is looking at.
Well, let's keep talking about the street and about the idea of consensus, Barry, because there seems to be a great deal of consensus right now on what is going to happen next year. And that is, we are going to end up at essentially the same place we are now, but it's going to be a trip downward and then back upward in order to get there. Do you get nervous when there seems to be that kind of consensus? Because when I hear everyone singing the same tune, I feel like it's more likely they're all going to be wrong.
Yeah.
Yeah, the notable times when everybody has been saying the same thing. I remember back in the fall of 1999, everybody was convinced trees grow to the sky and there's no stopping. And go back to March 09 and, hey, markets are going to zero, the economy is over and credit is frozen, and we'll never see any sort of recovery. That consensus has a tendency to reflect human emotions, and when the crowd gets really enthusiastic, hold on to your wallet because bad things are going to happen.
Don't we price in, though, events? I mean, yesterday we were talking to Matt Maley at Miller Tabak, and he said we need to go down to 15 times forward earnings before we can, see an end to the bear market. That's historically what happens in a recession, then turn back around. On the other hand, Catherine Rooney Vieira was just in here with us, and she said, maybe the market has seen past that and is already pricing in the recovery. Can you just skip past pricing in a recession if you're that confident that a recovery comes on the other side?
Everybody is so focused on the here and now, this moment, we sort of lose context of the bigger picture. We've discussed the concept of mean reversion before. Let me just remind everybody, from 2010 to the end of last year, markets had gained 13, 14% a year. That's nearly double historical averages. So while we're all coming up with these wonderful narratives explaining what's going to happen, I'm comfortable with the concept that you can't grow at double market rates for much more than a decade before there's a little bit of mean reversion. So is it the Fed? Is it earnings? Is it inflation? Maybe, or maybe this market just ran too far too fast on fiscal stimulus, on zero rates. And hey, now we're kind of resetting. It does look like the markets have priced in a mild recession. Hey, down 20%. That's a mild recession. I don't know if the markets have priced in anything more damaging or a hard landing.
Well, if we could take one stock as an example of what you're describing, Barry, in 2021 or 2020 to 2021, Tesla was up about 58%. Then it's down 69% this year. Can we just get your hot take on what is going on with a stock that used to be so high flying, worth worth more than $1 trillion at the beginning of this year, and has just seen all of that, or a large part of that, completely evaporate? It's been obliterated.
Sure. So let's look at this in 4 phases, 2 up, 2 down. The first phase was, hey, Elon Musk slapped a bunch of laptop batteries in a Lotus, a little roadster, and essentially that was the birth of the new EV industry. And for a decade, they had that industry to themselves. They were way ahead of everybody else technologically, over-the-air imports, the interface, the management of charging, the charger network. Nobody was even close. They were a decade ahead. So that was phase 1. Phase 2 was when everybody kind of figured out late 2019, early 2020, or maybe it was late 2018, early 2019, that, hey, as soon as Tesla starts to become profitable, they're a lock for being added to the S&P 500.
Which
every trader I know, every hedge fund I know, all front ran the major indexes, saying this has to be bought by BlackRock, Vanguard, State Street, everybody else. And so we're going to get in ahead of it. And that's how you end up with a $1.2 trillion company worth more than all the other automakers combined. Now, the back half of that. So now 1.2 trillion is ridiculous. Competition is coming. Ford, Mercedes, BMW, Hyundai, go down the whole list of all the hot new EVs that are out. That's before we even get to startups like Rivian and Lucid.
Right.
And so competition starts to take some wind out of their sails. The wild price competition, suddenly they're not dominant market share as far as the eyes can see. Eventually, they're going to give some back.
And then the stock gets punished.
and then he makes the call this year to buy Twitter.
Right, which is an entirely separate issue. Barry, unfortunately, we have to leave it there, but come back. Barry Ritholtz, thank you so much. Tesla up 69% in 2020, 50%.
Down. Oh, up 69% in 2020.
In 2020, 50% in 2021, down 69% in 2022. From New York, this is Bloomberg.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of the solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg Surveillance on TV and radio. Alongside Matt Miller, I'm Kaylee Lyons, in for John, Tom, and Lisa this week. We have just about an hour to go until the opening bell rings here in New York City. So let's get up to speed on all of the market action. Bloomberg's Kriti Gupta is joining us with that.
Yeah, Kaylee, we are seeing green on the screen. Of course, it is coming under our favorite words this week: thin liquidity, light volume. That is certainly the case. The S&P futures up about 0.2%. Not much different than a couple of hours ago when I checked in with you last. Russell 2000 up about 0.2%. A little bit outperformance, at least ahead of the opening bells across the Atlantic. The stock 600 up about 0.3%. But once again, no one is really trading right now. So I would say the stock market around the world is kind of on autopilot. But I will say this: it's almost at the whim of the dollar. And this has been a theme that you have seen all year long. If you look at a one-year chart for our radio audience, stick with me. Every time you see the dollar actually strengthen, the idea that interest rates are going to be driving essentially the trade, the stock market drops. We actually are seeing the futures do kind of the same thing this morning. Every tick higher in the greenback is actually moving the stock market both higher and lower. So as we see a little bit of a pullback in the Bloomberg Dollar Index today, futures are actually thriving after that. But there is a ripple effect that goes beyond that. The 10-year yield is what comes to mind, because the 10-year yield is actually down quite a bit, down about just 2 basis points. I say quite a bit because it's been kind of unchanged for the past 2 days. So to see that move, pushing the dollar down a little bit. The dollar, by the way, weaker against all major G10 currencies, the exception being one, and that, of course, is the Japanese yen. Kaylee, Matt, we know overnight the BOJ came back and boosted their purchases again, which then weakened the currency. Once again, we're looking at a 133.75 handle on dollar yen. And I should end it with the Bloomberg Commodity Index here. As we see the dollar weaken, you would think the commodity complex should be higher, but nevertheless, you are actually seeing it lower by the 0.2%. The only exception there being copper, which once again comes out of the Asia story. China reopening is creating a little bit of a floor under copper prices.
All right, thanks very much, Kriti Gupta there with a look at the effects of China on the commodities sector and the market overall. I want to bring in right now Claudia Sahm, founder of Sahm Consulting. She's a former Federal Reserve economist and one of my favorites because, Claudia, I can see you care about people in your work, which is something that doesn't always come through in economist research. You also went to Denison University, but I feel more like you're an Oberlin person. So I want to talk about the recent column you wrote, Ban the Phillips Curve, and the idea, or is it Ban the Phillips Curve? Yes. The idea is that to get inflation down, the Fed has to push unemployment up, which I guess makes sense, because otherwise how else do they affect sticky services prices? How is that wrong? And what should the Fed be doing differently in order to, in order not to destroy the lives of working Americans?
So I think what a big lesson of 2022, which has been extremely disorientating, right? We've had 50-year low unemployment. We've had 40-year high inflation. It is time to at least to scrutinize the rules of thumb, like the Phillips curve, that have been used by macroeconomists for a long time to think about what's that trade-off. the low unemployment just means that people have less money to spend. Most Americans, it's their paycheck, right? And low unemployment means that people all the way up and like working up into the middle class, they have money. That's not a bad way to think, maybe, about the trade-off when it's all demand driven, right? A lot of stimulus checks, a lot of money, big wage increases. But honestly, we have a pandemic. It is still affecting China, other parts of the world, and we have a war in Europe. So you really shouldn't use the Phillips curve. It's a really nice rule of thumb. It'd be great if it worked and helped the Fed calibrate everything. But come on, like this is a lesson at this point. We are in uncharted territory, and thus we got to dig deeper in terms of what the Fed does.
So how else? Because inflation also is, I mean, Ronald Reagan, I'm sure one of your favorite presidents, described it as like an armed robber or, you know, a boogeyman that really steals from especially the working classes. And it's very high right now. And then if you look at the non-accelerating inflation rate of unemployment, NAIRU, that shows that when unemployment is below a certain level, it's going to be inflationary, right? We were talking with Catherine Rooney Vera earlier, who said that unless you get up to 4.9%, these low levels of unemployment are inflationary. Do you disagree with that?
The NAIRU is a made-up number. I mean, it's with a lot of judgment and data, but running up until COVID started, the Federal Reserve, most of the macroeconomics community was like, this thing is broken in many ways. The Federal Reserve showed they have no idea what NAIRU is. Despite a lot of effort, it moved consistently downward after the Great Recession because unemployment kept going down and down and inflation did not spike. And we really don't know, given all the disruptions in the labor market, particularly the massive drop in the labor force participation, it hasn't come back. That affects the unemployment rate. The things that we have looked to as signals, as a way to think about what is this equilibrium, like what would normal and sustainable look like, is really hard to know what that is at this point. Now, you got to do something. And I think this is where the Fed has to get back, leaning into the data. We have seen inflation coming down without wage growth really slowing. And so that tells you there is at least some relief that comes without the Fed pumping high interest rate increases, fast interest rate increases into the economy. It's time to be a little more patient and really look at the early stages of the data. It takes a long time to get to consumer price inflation.
On the subject of consumer price inflation, or really just inflation generally, the Fed looking obviously the PCE deflator, and the idea of made-up numbers, or at least arbitrary numbers, 2%. It's what the Fed set its target at. Granted, it moved to average inflation targeting, but still, that's what they're striving for, something like that 2% number. Is that no longer a number fitting of the new world in which we live in, post-pandemic, post or still ongoing war in Ukraine? If we're looking at structurally lower labor force participation, structurally higher energy costs, should they be rethinking 2%?
It's far too early to have that discussion. And I think, honestly, it muddies the water and it makes the Fed fight even harder to get 2%. They are extremely concerned about their quote unquote credibility. I mean, I'm not sure who right now still questions the Fed is going to fight inflation, but I guess they're out there. And there is still a path as we come out of the pandemic, as the supply chains, as the rotation in the economy from goods back to services happens, we have a path back to 2%. It's far too early. That's a conversation for maybe this time next year or middle of the year after. But I don't see any reason for the Fed to be moving that 2% target. If we get back to something that looks kind of sort of like normal on the other end of this, well, they couldn't even get 2% before COVID showed up.
Okay, fair enough. But it raises the question of, especially as you mentioned China, how it's still been shut off from the world. It led to a lot of supply chain issues that were very inflationary. Now it's opening back up rather rapidly. And the surge it's dealing with currently aside, in the medium term, in theory, that's going to mean more demand for commodities, could be a fueler of inflation. How do you filter that back into your thinking about the trajectory of inflation and how monetary policy has to respond to it?
And that's not the only thing, right? We've got a $1.7 trillion omnibus. You've got deglobalization, which has to lead to at least some inflation as well, or at least less disinflation.
So absolutely what's happening in China and reopening is a wild card. And we know that the Fed has very limited tools to deal with commodity price inflation. The energy inflation, we still have a lot of food inflation, and that is not something that interest rates are going to chip away at. And, you know, what's happening in China is extremely disruptive, tragic as they're trying to reopen. And every time COVID came back, whether it's in the United States or big waves globally, it set us back in terms of getting back to normal, right? This has been very disruptive as things close down, open back up. So I totally agree on the commodity space that could be a tough one. And that was a lot of the problems the Fed had, a lot of the inflation concerns of the past year when we had the big spike in energy prices, particularly gasoline. So yeah, we are not out of this. There is a path back to something that looks like normal in the United States. On the globalization, I would be very careful about taking the last few years, which have been extraordinary with a pandemic and a war in Europe, to project big structural changes. That takes time.
Fair. And it's very difficult to do. Claudia, you know, for years now, income inequality has been on policymakers' radar, and you could argue that that's what drove the big populist forces that we've seen globally. Has the pandemic made income inequality worse, or have we made any progress in pushing back against that?
During the pandemic, so in what we've seen so far, the fiscal policy, the labor market coming back strong, that made a big difference for, you know, the bottom 50%, middle class on down. Because for the first time in many decades, we have had a job full recovery. And that really makes a difference for the vast majority of people. Now, and so you see in wealth inequality data that the increase in what, you know, families, bottom 50% have in the bank, it is enormous relative, particularly to after the Great Recession. So we have done some things to narrow that inequality. Now, I mean, the top is doing well, right? Even with some correction right now in the stock prices and our billionaires out there, I mean, they really their recovery came fast as usual. And yet I think it opens up some big questions. It's like, can our economy handle a job full recovery? And we need to have those. So there's a lot to figure out why this caused so much disruption. And yet we really did help people who haven't gotten a lot of help.
Claudia, great having you on the program. Thanks so much for joining us. Really love reading your research and your pieces. Claudia Sahm there of Sahm Consulting talking to us about maybe the Fed should look at things a little bit differently than it typically has. By the way, I was being sarcastic about my Reagan my comment, but I did find the quote. He was famous for saying, inflation is as violent as a mugger, as frightening as an armed robber, and as deadly as a hitman, which I think is something that people don't really appreciate anymore. You know, when I was a kid, we had just gone through the 70s and 80s. Volcker had to drive rates up to, you know, super Powell levels in order to fight inflation. And I think we just don't understand how bad it is for people. Maybe now we're getting a new taste of that.
No, it can cause a lot of pain, especially for those who are trying to feed their family, who drive their car to work. They have felt it in a very real way, and obviously that created a political problem as well. But inflation dynamics, Matt, I know is something you'll continue to discuss on The Open in the next hour.
Yes, I will. I'm coming up on The Open. Robert Tip coming up as well with me in John Farrow's absence. We miss you, John. This
and
is
Tom,
Bloomberg.
And Lisa.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Stranded travelers in the U.S. could face days of waiting to get to their destinations if they're booked on Southwest Airlines. The carrier has already scrapped 60% of its flights today and about 58% of tomorrow's. Meanwhile, in western New York, the death toll has risen to 31 from that record-breaking storm. The city of Buffalo is digging out from more than 4 feet of snow. In Hong Kong, the government is making a sweeping overhaul of COVID policies. It's an attempt to revive the city's reputation as a global financial center. Hong Kong will scrap limits on public gatherings and no longer require proof of vaccination for entry to some venues. Customers of failed cryptocurrency exchange FTX have filed suit in Delaware bankruptcy court. They're hoping to be first in line to recover some of the billions lost in the meltdown of Sam Bankman-Fried's digital asset empire. The suit asks the judge to give customers repayment priority over other FTX creditors. Newly elected Republican Congressman George Santos poses a test for GOP leader Kevin McCarthy. Santos has admitted he fabricated stories of jobs at big banks, college degrees, and property ownership. McCarthy hopes to be elected House Speaker next week and needs every vote he can get. In the past, Santos might have been the subject of an ethics inquiry. McCarthy isn't saying what he'll do. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority. From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
Chair Powell's been frustrated by some of these rallies in the market, these undesirable rallies that ease financial conditions when they're trying to slow the economy down. By holding a longer string of rate hikes over the market, I think that they hope to kind of prevent that relief rally that you're sort of alluding to, that they can hold markets in check for a little bit longer.
Julia Coronado, Macro Policy Perspectives President and founder, speaking with us about whether or not the Fed needs to push back on easing financial conditions. A relief rally faded throughout the day yesterday, and in the future session, the earlier semi-rally looks like it is fading as well as we get closer to the opening bell just under 45 minutes from now. S&P 500 futures falling back toward the zero unchanged level. Right now, we're up less than 0.1% at 38.58. And in the bond market, we do still see a bid in, though we are off of session lows on the 10-year yield. Right now, down about 2 basis points to 3.81. And of course, it has been a brutal year for bonds and stocks. The worst year for the 60-40 portfolio going all the way back to 2008. The worst year for the U.S. equity market going back to that year as well. So let's talk about one area of the equity market in particular and bring in Gerard Cassidy. He is head of U.S. bank equity strategy at RBC Capital Markets. Gerard, great to speak with you. As I said, 2022 has not been a good year for stocks broadly. One would think with borrowing costs moving up, it would have been a better year for bank stocks than the broader market. And yet I'm looking at the KBW Bank Index down by about 25%, which underperforms the broader S&P 500. So how do you expect the banks to fare performance-wise as we head into 2023 with recession risk front of mind?
Kayla,
You're absolutely right. The banks have struggled in 2022, and if you look at it by quarter, it was very interesting what happened. At the start of the year, the banks started out very strong, as everybody anticipated the strength in net interest revenue growth was going to benefit from the rise in short-term interest rates. But then the Fed got very hawkish, and sadly, the Russian-Ukraine war broke out, and the banks really sold off because of credit risk. But then, as you probably saw, from July 1 through the end of November, the bank stocks outperformed the markets because people realized that the revenue growth from the higher rates that was being orchestrated by the Fed was going to overwhelm any higher credit costs. That all went out the window in the last 4 weeks, and the stocks have sold off once again due to credit risk. So I think you put your thumb on it. In 2023, it is going to be a fight between rising credit costs versus revenue growth. And we happen to believe there are many banks that are going to be able to generate revenue growth that will more than offset the higher credit costs. And we'll probably start to see that showing up in the fourth quarter numbers, which will be reported beginning January 13th.
Right. It's those results that are really going to set the tone for bank stocks in the new year as those prints come about 2 weeks into it. What are you expecting we will see? How much weakness in some of the investment banking areas and the deal making IPOs, which we know have been slow in 2022, and how much will that be offset by better net interest income and then also trading?
Yeah, you bring up a really good point. The investment banking business has been very weak in 2022. The IPO business has essentially shut down. The ECM numbers for the top banks are down anywhere from 75 to 80% for the full year. Merger advisory businesses are probably going to show weaker numbers as well. And then the DCM market has also been weak. So you're right, the trading area has been able to offset some of that, but the numbers have been very weak. Now, what's interesting is the diversified universal banks like the JP Morgan, Bank of America, Citi, they also have obviously the traditional commercial banking businesses that offset the weakness in those areas, whereas Morgan Stanley and Goldman, which are more pure plays on investment banking, obviously don't have those offsets.
So what do you expect the tone to be from the management of these banks as they look ahead to a new year? Do we see a recovery in the pipeline in IPO and deal-making activity, or do you expect that that is still going to be a persistent struggle?
I think it's going to be a struggle for at least for the first 6 months. And the reason being is the Fed is still in monetary tightening phase, if you will. And so as they continue with their QT, which is likely to continue throughout the year, and raising short-term interest rates would, at the very least, will probably go into the spring until we get to a terminal rate of about 5%. Because of that, I think the equity markets are going to be very choppy in the first part of the year. It's going to be very tough to revive the IPO markets. The other thing, too, Kylie, is that how do the investment banks convince many of these private companies that were valued, considerably higher in the spring of fall of 21, and now, their valuations are down 75, 80%. How do you convince them to go public when they remember those higher valuations? It's going to be very difficult. So I think it's going to be a real tough year in the first 6 months, then start to get better in the second half of the year for the investment banks.
Yeah, definitely a very difficult time to come to the public markets, Gerard. You mentioned, though, the banks that are more oriented or have greater exposure to the consumer, which raises the question of loans and demand for them. Obviously, loan growth was very hard to come by during the pandemic because people just didn't need to borrow. Now, if people want to borrow, they're facing a much higher cost to do so. So what are you expecting on the loan growth side?
It's interesting. Loan growth has been extraordinarily strong. We track it every week. We write about it on Friday afternoons from the Fed data called the H8 data. And as of last Friday, year-over-year loan growth is around 11, 12% for the industry, which is remarkable. And normally loan growth will grow at nominal GDP growth. So let's assume we do have a recession next year. Say the real GDP number for full year 23 is minus 1% or so. And then inflation comes down to 3 to 4%. That will still give us nominal growth in GDP next year of anywhere from 2 to 4%. So loan growth next year should probably come in around that level, maybe a tad higher from both consumer and corporate. And that's the other part of the story is the banks have dealt with disintermediation for 30 years. Well, there's been now re-intermediation, meaning banks are now gaining market share because the bond market is still disrupted due to the monetary policy of the Fed, and the banks are gaining share, particularly in the commercial lending area.
What about loan loss provisions? How much do you expect those could move up, given what you are describing as a softening in the economic environment, potentially a recession?
You put your thumb on it. That is the key number this year. Is going to be how much will the banks have to set aside. They're coming into a slower, possible recessionary year in very strong credit shape. And we have to remember, too, is that the largest banks go through an annual stress test due to the Dodd-Frank law that came out, following the financial crisis. So the banks, I think, are in very good position to handle the slowdown in the economy / recession. Now, that doesn't mean provisions are not going up. Of course, they're going to go up. And the question is by how much. And that's a hard thing to project. We know they're going to go up. We know credit losses, which are near 4-decade lows, are going to go higher. But we think it's manageable. And we think this net interest revenue growth in 2023, which for many, not in all the years of doing this, I don't ever recall banks posting 25-30% net interest revenue growth, which is happening now in 2022. Next year, it is going to slow, but down to about 10 to 11%. Still plenty of growth to cover these higher credit costs. So credit costs are clearly going higher.
And Gerard, finally, you say that banks are well positioned heading into a recession, but that doesn't mean that the leaders of them don't have to make difficult choices if things are slowing down. And knowing that a large part of our audience are bankers, those listening and watching right now. So what is your expectation in terms of the decisions banks are going to be making around their workforces, be that actual layoffs, be that just reduction in compensation and cost cuts more broadly?
I think it's going to be a tale of two cities. The commercial banking business is going to remain okay. In fact, there'll be more people repositioned into the loan workout areas in 2023. Investment banking is still under pressure. As you know, we've had some layoff announcements already in the fourth quarter. We expect more to come if the business doesn't come back. But the traditional commercial banking business, the companies like KeyCorp or PNC, these companies are continuing to look for growth because they're in the basic commercial banking businesses and not pure investment banking like a Goldman or a Morgan Stanley.
All right, Gerard Cassidy of RBC Capital Markets, thank you so much for joining us on this holiday week. And I'm sure we will be hearing more from you just a few weeks from now when we do start to get those bank earnings rolling out for the fourth quarter. JP Morgan will be kicking us off on January 13th. Let's get a quick check, though, on the broader markets. As we draw closer to the opening bell, just about 35 minutes to go, we are seeing the gains in the future session beginning to roll over. Right now, S&P 500 futures are up less than 0.1%. Only by about 2 points are we higher at 38.57. In the bond market, we are seeing that drop in yields reverse a little bit as well. Earlier on, the 10-year yield was down about 4 basis points. We're now only down a single basis point at 3.82%. And interestingly, despite the reopening news we continue to get out of China and Hong Kong, you are not seeing a bid coming in for oil. WTI crude right now down about 0.7% at $78.96 a barrel. That wraps it up here on Surveillance, but stay tuned to Bloomberg Television and radio throughout the day. Balance of Power coming up later on this afternoon with Chris Smalls. He is president of the Amazon Labor Union. This is Bloomberg.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full service shadow banking with nobody in charge.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years. Or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is you should take jobs where you're learning And if you stop learning in a job, then you should quit. And like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question. Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
From New York City, for our viewers worldwide, I'm Matt Miller, in for John Farrow. We see markets on an upswing right now, with S&P futures up 0.1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
All right, the gains are definitely looking tamer than they were earlier this morning, and that's the big issue, fading hopes for a Santa Claus rally.
The Santa Claus rally.
The Santa Claus rally. We were thinking we were going to have this really, nice rally into the end of the year.
The idea that the Santa rally is here to deliver a nice end to the end of 2022.
The market is setting a different signal.
The legs are really being chipped away from that from a variety of directions.
It could be a more challenging few weeks.
There's so much bearishness out there right now.
There's a lot of pessimism out there.
Volumes have actually remained kind of steady.
There's uncertainty.
The bear market rally we had did its job.
Not a great December.
Part of the problem in the US is that the equity market had a fantastic November. So Christmas just came early.
Joining us now to talk about this and the outlook for 2023, PGIM's Robert Tipp, as well as Samir Samana of Wells Fargo Investment Institute. Gentlemen, thanks so much for your time on this holiday week. Samir, let me start with you. You point out it's not a time to be buying equities, and it looks like the market broadly agrees with you. When will we see that turning point?
I mean, history tells you it's going to be a lot closer to the recession, and history tells you that it's going to be a lot closer to when the Fed is actually considering cutting interest rates, not pausing interest rates, not making smaller interest rate hikes, when they're actually thinking about cutting interest rates. So again, for all those different reasons, we think the low probably happens sometime in the first half of next year.
So, Robert, you are the Chief Investment Strategist, Head of Global Bonds. But you've got to look at these equity markets as well. So tepid, right? We were looking for over 4,000 by year end. But the target, if you look at our survey of strategists, is the same for year end 2023. What does this tell you about the investment environment?
Investors have been beaten down. And I think, one of the key linchpins on expected asset returns here is going to be volatility. And volatility, obviously, last year was very, very high. And volatility is terrible for bonds. Now, I've been very positive on equities for a long time. They've benefited from the growth in the economy. They've benefited from the low interest rates. Right now, we have high interest rates. That's hurting the equities, but it's a big positive for bonds. And the expected volatility, the uncertainty out there, is likely to decline next year relative to what it was in 2022. And as a result, that's likely to be a bit of a headwind for equities. but a tailwind for bonds, high yield bonds, corporate bonds, all kinds of spread product, which do very well when volatility falls.
Samir, you're the global market strategist at Wells Fargo, and Robert points out volatility has been brutal. It's been worse for him, I think, for fixed income than it has been for the equity world. Does that continue into 2023, that kind of volatility?
Yeah, I mean, look, the fixed income markets probably are running ahead of the equity markets, and from that standpoint, you know, one of the things we did recently was we did lengthen duration. We had been neutral on kind of the longer end part of the curve. We just took it to most favorable, you know, when we were north of 4 on 10s. So I think, you know, there much of the adjustment probably has taken place. Unfortunately for equities, I just can't imagine, you know, volatility falling further in the first half of next year. I mean, I appreciate that, you know, the first part of this year was a little rocky, but I mean, you're back to a VIX that was sub 20 just the other day. So I can't imagine this ends with, you know, volatility already having peaked, again, with the Fed rate hikes, with kind of the recession ahead of us.
What about, Robert, the possibility of volatility having peaked in global bonds? It was an annus horribilis for fixed income, as we just heard earlier from Invesco. Do you see that coming to an end with the end of this year?
Absolutely. Yields are spectacularly high relative to where they've been the last 10 years. This is a complete reset. Yields on the major bond market indices are back to where they were, say, in 2002. So this is a reset, and the bond market is really set for an outstanding decade of returns ahead. You know, are we a little bit overbought on the back end, oversold on the front end? Is spread product, is it a little early? Is it a little late? You know, all those tactical questions are going to loom out there, but big picture, strategically, this is a spectacular point for bonds here.
Let's talk about global bonds with Abigail Doolittle right now. It was a brutal year of losses, as everyone who's been watching knows. Rates maybe at generational highs, as Robert suggests. The end-of-year sell-off prompting the Bank of Japan to up their purchases, and probably the most interesting central bank action we've seen since the Fed decided to start raising. Bloomberg's Abigail Doolittle has more to tell us on this issue. Abigail?
Well, Matt, you know, it's interesting, never a dull week, because here we are in the final week of 2022 from a trading and a calendar standpoint, and it should be one of these quiet weeks, but we do have this big move from the BOJ, basically an unscheduled bond buying operation. Before we go into that more, let's set the stage. And of course, yesterday we were talking about how yields here, bonds here in the U.S. recently just doing a little bit better over the last couple of months. But over the last few weeks, we have had a renewed global bond sell-off from the U.S. 10-year bonds to the JGBs to German 10-year. This is all price that we're taking a look at, down more than 6%. Now, the narrative is really interesting, Matt. It has to do with that China reopening, the world's second largest economy, that inflation may stick around, or you could think about it another way. These tend to be havens that if the economy is getting back on track, that it could, in fact, create less need for havens. Now, the most interesting effects from the BOJ's announcement, and that is to basically buy unlimited amounts of 2-year notes at a fixed yield of 3 bips, 5 years at 24 bips, in addition to the standing 10-year note buy at 50 bips, is on currencies. Take a look at not so much the dollar against the yen, a little bit of a bid there, but the Aussie and the New Zealand dollar, the Kiwi, both up more than 1%. Those economies tied closely to China. And then relative, Matt, to that global bond sell-off that you were talking about, let's take a look at it from a yield perspective, because it is ferocious. The 10-year yield here in the U.S. up 2.32%, the UK gilt up 2.7%, German up about a similar amount, and then the JGBs that the BOJ right now is trying to suppress to some degree. It's interesting because it seems to go in maybe a little bit of an opposite reaction to what they were talking about just a couple weeks ago. It's up 40 basis points.
Yeah, I think the BOJ is one of the most interesting stories out there, if a little removed from where Americans are investing today. Let me get back to Robert Tipp and Samir Saman. And Samir, let me ask you, you say we need to get closer to the end of the rate hike cycle. We need to get closer to inflation getting kept in check before we can buy. So you do see much more pain coming up, or I should say more pain coming up in 2023. And I want to ask you how much. Yesterday, Matt Maley said maybe 3,500 on the S&P, maybe even lower if we want to get down to valuations around 15.
Sure. So, I don't know how much lower we'll go. That being said, I think it's, now clear to us anyways that between 3,500 and 3,700 on the S&P that there's good value for intermediate to long-term investors. We've done a lot of work with respect to the bear market, both in price and time. And so in that first half is when we'll be looking for kind of opportunities to go shopping, right? We've got kind of our lists made. Will it be the bottom? Only time will tell. But again, now that we're almost a year into this bear market, it's low. I think we were almost off 30%. We've seen enough to kind of let us know that, okay, we want to kind of be, kind of on guard for, additional opportunities in that new year. So I think, again, 3,500 to 3,700 is the area we'll be watching for. With respect to, will there be additional pain? We think so. And I think, if anything, this most recent news out of China with the reopening being as quickly as it's happening probably complicates the Fed's, job with respect to putting a little bit of a bid under oil prices, putting a little bit of a bid under, inflation globally, through aggregate demand. So I think that's going to be one of the biggest things that we'll be watching in the first half.
It's a really good point, Samir. And you don't just have the reopening in China, which is essentially, or in some respects, an unknown, right? Because we were worried that maybe the COVID infections would outweigh the demand boost of reopening. It looks like the market has worried less about that over the last few hours. But you've also got this $1.7 trillion omnibus, and you've got, to some extent, the deglobalization impulse that has to have at least a little bit of an upward effect on prices. If we do see more inflation and the Fed has to go further, Robert, what does that do to rates? I mean, are you sure that we've hit the highs in rates? Are we coming down, or could we go back up?
Yeah, no, of course, you can't be sure about anything. But there's a lot more yield in this market. When you're looking at investment grade yields in this 5% area, now you have wiggle room. When the market yield was down at 1 3/4, when the 10-year is yielding 0.5%, when the bond is yielding negative 0.5%, that's the worst of all worlds. If yields go up, prices go down, and you have absolutely no yield to cushion you. At this point, you have a lot of yield to cushion you, and you have some leeway on the Fed. I mean, right now, the market is ready for the Fed to go up to 5%, and the Fed is telling you that they are hiking at a slower rate. In other words, they see their ending this cycle. They're coming towards the end of it. And you can clearly see the impact of their actions on inflation, on growth. So everything is in line for them to be leveling off either at current levels or within the next couple of hikes. The market's ready for that. So I think the risks in fixed income are really on the upside in terms of return. In terms of equities, it's much more balanced. They're going to have a headwind until there's clear signs of acceleration of growth.
We talk about what's the terminal rate. Voltic's Catherine Rooney Vera seeing a shrinking gap between the Fed's last rate hike and its first cut. Take a listen.
The yield curve is pricing in recession. We know that, but there could be a normalization next year. And my thing is, everyone's talking about how 2023 the Fed isn't going to cut. But if you look also at history, the past 14 monetary cycles, the last hike versus the first cut, that timing is much shorter than you think.
And we could already be nearing the last hike, right? If the Fed goes 50 basis points in February, that brings us to 5, and that's pretty close to what most people expect the terminal rate to be. Samir, is your window to get in then shorter if the Fed goes from, last hike to first cut pretty quickly?
Yeah, that's exactly why kind of our pencils are sharpened, and first half of next year is really the time that we're looking for with respect to trying to add risk. The first step was to add some duration. The next one will probably be to take on some credit and some equity risk. So yeah, that's exactly our plan. And, again, probably don't want to get too cute here because, history tells you that, maybe we need to trade at something in the low 3s. Well, look, if you're buying at 3,500, you're within 10% of that, and the upside probably is 20% plus.
Yeah, and if people are the market clearly is going to want to get ahead of the window, and maybe you don't even price in a recession anymore. Catherine was saying maybe people are already pricing in the recovery, and we skipped past the 15 15 times price earnings, forward earnings valuations that you typically would see. We're going to continue to talk about this stuff with Robert Tipp as well as Samir Samana. They are sticking with us, and we're going to talk more about what's going on in China. That's going to be the big news event, it seems, for markets at least, of this week. The rapid dismantling of COVID curbs.
We're still living in a perverse world where good news is bad news. And I think China is a cyclical thing that we have to look at as the largest economy reopens.
That conversation still ahead on the Open. This is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
The main factor of China is that the political events are now all over. They're getting a very, very cheaper energy input compared to advanced economies from the likes of Russia and Venezuela. And they've got a huge level of advantages because their interest rates are actually declining, whereas the rest of the world's interest rates are actually surging.
Hong Kong ending some of its last major COVID curbs. This as infections continue to surge on the mainland. Nations across the world are now considering their own provisions for travelers from China as bookings soar for Chinese people looking to leave on, I guess what we call revenge travel or vacation after being locked down for so long. Japan already implementing negative test requirements. The U.S. is weighing similar steps. Bloomberg reporting that questions remain around the transparency of Chinese data. Team coverage starts right now, right here. Bloomberg's Jordan Fabian down in Washington, D.C., alongside Justina Lee out of London. Justina, let's start with you. The restrictions continue to fall away, and it looks like Chinese people are itching to go on vacation.
Right, exactly. I mean, now with China issuing passports again and reopening the border, we're seeing a surge of bookings for, Chinese travelers. And that's one reason why tourism stocks have been surging today. And I mean, in addition to that, Hong Kong has also been talking about reopening its border with mainland China. And we're seeing a lot of those travel restrictions, kind of like test requirements in and out of Hong Kong being eased as well.
All right, there have always been questions about the transparency of Chinese data, at least as long as I've been covering these markets. But Fabian, the concern now is that that could cause COVID spikes here. What is the U.S. considering?
Well, they're considering measures like similar to what Japan put in place. So maybe requiring a negative test for travelers from China or doing some kind of enhanced surveillance. I haven't heard from any sources that there's any kind of consideration of more onerous travel restrictions or a travel ban. But the concern among U.S. officials isn't necessarily not necessarily the reopening, but the fact that, as you mentioned, there's this lack of transparency around specifically genomic testing. What they're really concerned about is a new variant creeping up in China because of the high rate of infections there, and then that in turn being transmitted by travelers coming from China to the U.S. and other countries, and then public health officials not being able to kind of track the genetic sequencing and be able to figure out if a new variant is in fact creeping up and then spreading worldwide. So that's why they're considering these measures.
So, Justina, what's the geopolitical fallout? I mean, Japan and the U.S. don't believe the Chinese data. At the very least, it seems kind of rude, right?
Yeah, and I think, China kind of has made it a lot harder for the rest of the world to judge what exactly is the situation there, because we've certainly heard a lot of anecdotal evidence on social media and in news reports about, the kind of the overwhelming number of deaths and infections climbing in the country. But at the same time, China changed the definition of COVID deaths, a while ago. And there have been reports of internal data shared within the Chinese government showing a far higher number of infections than have been released recently. And it does kind of feel like, they're starting to figure out that this situation cannot exactly continue. So they're trying to work on deciding what exactly to announce.
Well, they did announce last week that they had 37 million new infections in one day. So you can't imagine that it gets much higher than that. Justina, thanks so much. Justina Lee there out of London. Jordan, Fabian out of Washington, D.C. Appreciate your reporting this morning as well. Let's get back to our